You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession.
It's the volatility, it's the uncertainty. Where are we going from here?
The scarcity in the marketplace is certainty.
Investors are also very uncertain around the timeline.
Everyone knows there's going to be pain, but the issue is they just don't know that the cure seems to be worse than the disease right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Just double checking what day of the week it is. What a week. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Thursday as the White House chooses de-escalation.
Many of you in the media clearly missed the art of the deal. You tried to say that the rest of the world would be moved closer to China when in fact we've seen the opposite effect. The entire world is calling the United States of America, not China, because they need our markets, they need our consumers, and they need this president in the Oval Office to talk to them.
The president backing down, authorizing a 90-day pause on major reciprocal tariffs while choosing to double down on China.
So every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
One social media post sending equities to their biggest one-day gain since 2008 and offering some support to a nervy bond market.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy.
The bond market very much in focus going into inflation data later this morning. The latest read on consumer prices, that number is just around the corner.
And that number won't probably matter very much at all at a time where President Trump, whether some people are saying that now we've reached a new level of calm, not quite so much. It is unclear to see what kind of data could supersede what we saw yesterday, which sure, on one hand, gave us some insight. Number one, it took the worst case scenario off the table. And number two, it showed that, yes, he does care about markets, the bond markets, and that they do have a call. They do have a strike price. It's just not maybe as comfortable as we previously thought.
Check out the equity market this morning. We're down again. We're down by 2% on the S&P 500. We're down across the board. We've got 10% baseline tariffs still. We've got 125% tariffs on China. Goldman's Jan Hatzius putting it this way, Anne-Marie. We've gone from a recession-level increase to a still very growth-negative increase.
There's still a tremendous amount of uncertainty when you look at what's going on in China and the tit-for-tat and the rhetoric you see out of China and Washington, D.C. Many economists are looking at this, and they're basically saying this is decoupling when it comes to goods between these two economies. And then it comes to the 10% baseline. Donald Trump talked about this on the campaign trail. There's going to be a 10% tariff wall. So he's going back to that promise. The issue is when it comes to the reciprocal tariffs, it's a 90-day pause. It's a reprieve. It's a halt. What happens when he doesn't get the deals he wants for some of those top trading partners? We're going to be doing this for weeks and months on end.
The uncertainty remains. Sure, we've taken the temperature down over the last 24 hours, but for many people, investors, officials alike, business leaders, they face similar risks this morning.
If you're counting on the psychology of one person whose insight into his decision-making process was, it was fluid. I just did it on the fly. It was an impulse. It was a feeling. It doesn't give people confidence in how to predict. How do you trade in a market where 6 stocks can gain $1.7 trillion in market capitalization in one day?
I heard that maybe he just wants to relax and watch the Masters over the next 4 days. Maybe that's what this is about.
So we're basically going to look at the golf schedule and then decide when things are going to ratchet down before they ramp up again. Again, this goes back to what does this do over the longer term to U.S. assets? I think it's notable that the dollar is weaker again today and that gold was the best performing asset that had a best day yesterday in a couple years. To me, that speaks to the moment we're in.
Rory McIlroy teeing off at 1:12 Eastern Time. Coming up this hour, Russ Koesterich of BlackRock on tariff whiplash, Andrew Bishop of Signum Global Advisors as the White House backs down, and Subadra Rajappa of SocGen as Trump watches the bond market. We begin this hour with stocks falling following their biggest daily gain going back to 2008. President Donald Trump announcing a 90-day tariff pause on most trading partners. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. Let's just start with where we are and where we might be in 90 days' time.
Yeah, hey, John, good morning. Well, that 90-day pause only applies, as you've been discussing, to those so-called reciprocal tariffs, but that 10% levy is still in place across the board, plus that 125% tariff escalation with China, not to mention that Canada and Mexico didn't see any reprieve from this because their plans were never rolled in to the so-called reciprocal tariff plan. But it does appear that this White House did have its limit, particularly after really downplaying the investor concerns in recent weeks. You heard President Trump yesterday indicating that the market turmoil did have an impact on this decision. He said he felt that people were getting, quote, yippy, a little bit afraid when it came to the economy. And of course, as you've been discussing, pointed out explicitly that he was watching the bond market amid, of course, as you know, these heightened concerns about the future stability of the debt markets. Now, interestingly enough, Treasury Secretary Scott Bessent did come out yesterday and he said this was the plan all along, that this shows the White House wants to negotiate in good faith, and it actually gives the U.S. more leverage in these negotiations. But we should be clear that President Trump said that this decision was only made yesterday morning after earlier in the week dismissing a pause altogether. Now, John, the Treasury Secretary did confirm that he does have meetings on the books with Japan, South Korea, Vietnam, and India. But it might not just be countries that are soon negotiating with the U.S. President Trump was asked if he would consider exemptions for companies, and he said that those would be coming in the future. But when asked how he would make those determinations, he said that it would be based on his instincts.
Tyler Kendall with the latest from Washington. Tyler, thank you. The door just slightly open for one particular company, Apple. Can we have some exemptions in the months to come?
Absolutely. And I'm sure Tim Cook is putting on his diplomatic hat, calling the White House and saying, look, something needs to be done, or we're going to be dealing with $3,000 North iPhones, which I don't think you want to have under your presidency when it comes to a consumer that's pushing back on higher inflation.
Futures down across the board this morning. NASDAQ futures down by 2 percentage points. A wild start to the week in financial markets. Russ Koesterich of BlackRock joins us now for more. Russ, a big change, a U-turn from the President of the United States. Does it make you more bullish on equities or on bonds?
I'd say right now it makes us cautious. Good morning, Jonathan. We have been pulling in risk for a while. Clearly, yesterday was a relief. Market took it as such. But, as I was looking at a report this morning, you often get these big rallies during periods of turbulence. Our view is that you're still in an environment where policy uncertainty is heightened. You're also in an environment that wherever you came into 2025, whatever your economic assumptions were, they've got to be lower today. So if we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
Russ, in the past, that would mean going to bonds. This time around, is that still true?
Well, we have been raising our allocation to bonds. We're underweight, as you might remember, over the last few years, we've been talking about it. Generally modestly underweight bonds, particularly on the long end of the curve. We've been bringing that back closer to benchmark. And I'd say that is more of a reflection of the economic environment than trying to make a bet on policy. Now, if you do have an environment where growth is going to be slower, it's not crazy that your bond allocation is going to be closer to home. But by the way, we've done a similar thing in equities. We brought our equity allocation down closer to benchmark. So, what's happened, generally lowering the risk in the portfolio in this type of environment, rather than a strong bet on you want to be in bonds and equities, you want to bring risks down.
Maybe the larger question is U.S. assets versus ex-U.S. assets at a time where the source of volatility is the United States, and this has to do with bonds, but more broadly with dollar-denominated assets. Does it make you rethink some of what you have in your portfolio based on where the source of volatility has been coming from?
This is a great question. I think this is actually a harder question to answer, but what I would say is I don't think you have a knee-jerk reaction to move away from dollar assets. Couple of points. First of all, we might remember 2011 during the debt ceiling crisis. The U.S. gets downgraded, the epicenter of the crisis. What happens? Treasury bonds go up. The dollar is still the reserve currency. We can debate what's going to happen in 5 or 10 years. It is still a safe haven asset. And I do think that you've got to be skeptical about calling the end of dollar dominance. The other point on the equity side, we are still modestly overweight the U.S. Now, why would you do that with all the turbulence going on? Simple answer, we still find better companies in the U.S. We think about what do we want in this environment? We want profitability. We want companies that can generate consistent earnings. Still find more of those companies in the U.S. rather than Europe or Japan. So to my mind, even with the turbulence, from a bottom-up perspective, still an argument to be modestly overweight the U.S.
Given all the uncertainty, even whether or not Trump decides to blink, walk off the cliff, give these reprieves, do you still like gold?
We do like gold. Again, I think you have to trade around it. It's been a huge move. We like gold back 6 months ago. We definitely like it today. Couple of reasons. First of all, Annmarie, as you suggest, still a asset that works during times of turbulence. You look at the performance of gold when volatility is rising. And again, I think it's safe to say we're probably in a more volatile environment. Generally does very well versus stocks. The other argument is the long-term fiscal picture. One of the reasons we like gold is you can't print more of it. It is a store of value. It's still not obvious that there's going to be a significant improvement in the fiscal picture. If we are in an environment of these $2 trillion structural deficits, they're not necessarily going away. Having something that you can't increase the supply, that is a store of value in the portfolio, we think that makes sense over the longer term.
Russ, just wanted to jump in with some news out of the European Union. The headline just crossed on the Bloomberg terminal that the EU is considering pausing counter tariffs against the United States for 90 days, in line with that 90-day pause that the president announced just yesterday. Just taking the temperature down just a bit more this morning.
And I also think the European Union is looking around the room and saying, look what's going on with Japan. Look what's going on with South Korea. They are pushing out olive branches. They are saying they want to do deals with this president. He's come out and said you're going to get a 90-day reprieve. So why should we escalate? At this moment, maybe we should send a team over and try to de-escalate and come to a trade agreement.
The latest headline from the team here at Bloomberg that the European Union is considering pausing counter tariffs against the United States on metals for 90 days. Russ, just to bring you back into the conversation as we take the temperature down worldwide, how close did we come to an accident in this bond market? What did you see developing in the previous few days going into the announcement from the president just yesterday afternoon?
Well, I think the bond market move was definitely something we're paying attention. And it was not just the Treasury market. You'll remember that during the initial phases of the sell-off, credit markets were remarkably well behaved. That all started to change on Friday. We saw spreads back up dramatically. I think that gave a lot of people pause because now it's not just a matter of growth. It's a matter of liquidity. It's a matter of what's happening with the availability of credit. And that was something that definitely unnerved investors. If you see the bond market calming down, that's definitely a development that's going to give a little bit more comfort to the equity side of the market.
Things settling down in the bond market this morning. Russ, appreciate your time. Russ Koesterich there of BlackRock on the latest. The latest in fixed income. Yields lower across the curve. We're down 5 basis points on a 2-year. On 10s down a similar amount. Your yield this morning is 4.29. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. That move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. In China, the top leaders there are set to meet today to discuss additional economic stimulus in response to those increased tariffs. Sources tell Bloomberg that the meeting will focus on support for housing, consumer spending, technological innovation, among other areas. A check on U.S. steel shares in the pre-market down nearly 12%. President Trump has said that he doesn't want a Japanese company buying the steel manufacturer. Earlier in the week, the president ordered an additional national review of Nippon Steel's proposal to buy the company. The U.S. Committee on Foreign Investment has 45 days to finalize its review. And that's your brief, John.
Hey, Danny, thank you. More drama. More from Danny a little bit later this morning. Up next on the program, the president backs down.
We had to take the medicine. We had to go through the operation, and that's what we've been through. And a lot of presidents would not have done it. No president would have done it, I think.
That's for sure. Andrew Bishop of Signum Global Advisors joins us next, live from New York City this morning. Good morning. The latest from UBS this morning and the team. Trump blinks, but the damage isn't all undone. You see that again this morning. We're down 1.4% on the S&P. We're down 1.7% on the Nasdaq 100. Under surveillance this morning, the president backs down.
A lot of winning out there, and we're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Our country's stronger than it's ever been, and somebody had to do that we had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think.
It's the latest this morning. President Trump sending stocks to their biggest one-day gains since 2008 after announcing a 90-day pause on higher tariffs. The president making an exception for China, raising duties to 125%, and China responding to moderately reduce the number of imported US films. That headline just crossing the Bloomberg terminal. Ollie Crook, seconds ago. Ollie, let's talk to you, sir, in Brussels about how the Europeans might respond in the coming days and weeks.
Yeah, well, Jonathan, it's sort of hard to know because we're on our third global tariff regime, and it's just Thursday of this week. And this is what the basically European policymakers need to be sort of reacting to and really feeling a lot of whiplash. I mean, I've already spoken to a few today. Everyone is intensely relieved, but let's not lose sight of the fact that you still have 10% tariffs that are going from all goods going from the European Union into the United States. We're talking about 500 billion euros worth of goods. And let's not also lose sight of the fact that you have 25% tariffs on cars. You have 25% tariffs on aluminum and steel. And now the European Union has said, because they come up with these measures to retaliate, to hit $21 billion worth of American goods in retaliation just to the steel and aluminum, that is now on pause for another 90 days in order to have conversations with the United States. Of course, it was very difficult for the Europeans to get into a room with the Americans in the sort of lead up to this to get those negotiations going. They have wanted to have negotiations from the very beginning. But if you're a European policymaker today, how much reassurance are you taking in what you've gotten out of the Trump administration? We also know from sources that next week they're not going to deliver the architecture in retaliation to the reciprocal tariffs. They were originally planning to do that. But I suspect, John, they're still going to put up that architecture. They're going to have it written down somewhere. They're just not going to talk about it, because if this is a problem not today, maybe next week, maybe the week after.
Ollie, the press secretary called out the media yesterday in a briefing and said you tried to say that the rest of the world would be moved closer to China. Has Europe moved closer to China? What's your reporting in Brussels?
Yeah, there has been a little bit of discussion on that. So we were hearing something about that from the Spanish side. We know that Pedro Sanchez, the Prime Minister of Spain, the socialist from Spain, will be arriving in Beijing tomorrow. But whenever I spoke to policymakers earlier in the week, and I did drill these sort of different trade ministers about this, saying that basically if the U.S. is an unreliable partner, does that change at all your relationship to China? Does it change even how you think about it? They were very, very cautious about moving in that sort of direction. Because remember, before Trump was elected president of the United States, the biggest threat to Europe, they thought, was China. They have this whole new commission. It's all about European competitiveness and trying to push back against that Chinese threat. And again, that is sort of a caution that is well appreciated, I would say, by the Trump administration over the last few days, given what we heard from Scott Bessent saying yesterday that if Europe moved towards China, they'd be slitting their own throat.
Ollie, appreciate the update out of Brussels. Ollie Crook there, Bloomberg's very own. A lot to stay on top of over the last 15 minutes or so. So in the last 24 hours, the president is backing down on Europe and doubling down on China. And this is what we've heard so far this morning. Just in the last 10, 15 minutes alone, the Europeans weighing a pause on retaliation, and the Chinese reportedly moderately reducing the number of imported US films.
So there's trade war certainly happening between Beijing and Washington while it's cooling off, as the president said, be cool when it comes to everywhere else. China right now is going to reduce the number of imported U.S. films. This has been circulating in Beijing for a number of days. There was an illustration of a potential response from a number of Chinese bloggers that people watched to try to read the tea leaves of what's going on with the CCP. And they were saying it include duties on American farm goods and a ban on Hollywood films. And we're starting to see a lot of that play out.
Let's continue the conversation. Joining us now is Andrew Bishop of Signum Global Advisors. Andrew, welcome to the programme. Just describe for us what you think the next 90 days are going to look like.
So I think the most important thing to keep in mind, given the news yesterday, is that in Trump's modus operandi, a delay is not a cancellation. So I know that a lot of people are saying, you know, the tariffs have been put on pause, but that doesn't mean that the uncertainty is gone. I would go a step further. That doesn't mean that the tariffs are gone, right? And very tangibly speaking, what we've seen time and time again in the past with this president is that he'll hit pause, but will then actually move forward with a measure. So what I suspect may happen is that by the end of the 90 days, we may have perhaps a more competent team in place to actually see these tariffs through, but just with, a more professional framework in place and being rolled out.
Has the strategy somewhat changed to squarely focus on China and bring allies along for the ride?
So that's always been a hypothesis, and it's a hypothesis that gets a lot of backing from recent news, right? Given the president's decision to focus on China. We at Signum have been warning not to jump into these monocausal explanations, right? So up until a few days ago, it was a war against everyone with no negotiations. Then it was a negotiation with everyone. Now it's a negotiation with everyone except China. Our view, to be very clear, is that the president does not have a single motivating driver for his use of tariffs. And as he has himself said, the reason he likes tariffs is because he can accomplish many different things. So I would not focus too much on China, actually.
When it comes to this pause on tariffs, how does this work hand in hand with what they're trying to do on Capitol Hill? Because I thought part of the tariff regime is to bring in revenues to pay for the tax extension.
So our view at Signum has been that was never the goal, right? I.e., they will talk about that, they will say that it helps, et cetera, but that the president's approach to tariffs has always been and will remain more transactional than any measure really bringing in revenue would need to be, right? The exception to that is now probably the 10% baseline universal tariff, and that does bring in some revenue. But considering the fact that it's done outside of Congress, as you say, and the fact that it's not enough revenue, we really don't see it as a one-to-one measure with the tax cuts.
Andrew, what is your timeline now for the tax cut plan?
So the president, I think, and the president's team are trying to hasten it, right, and shorten it to sort of paper over some of the bad news on the tariff side. Our timeline has not changed, which essentially means that late summer at the earliest, around the period when Congress will go on a break, is the absolute earliest we could see a bill. And frankly, we lean much more towards post-summer.
Interesting. Andrew, thanks for the update. Appreciate it. Andrew Bishop there of Signum Global Advisors. So what do the next 90 days look like? Neil Dutta of Renmac. He says this: the issue is prolonged uncertainty. It weighs on investment. Consumers save more. Labour markets are still frozen. And his words, not mine, housing still sucks. Neil Dutta.
Well, this is the issue. Can you really put the genie back into the bottle, put the toothpaste back into the tube? This is what we've been talking about. To more tangibly talk about it, Amazon already canceled orders in China. We talked about Haas Automation, which already said that it was reducing production and in some of the hours for its workers. You start looking at the moves that companies are taking. They're taking risk down. They're not taking a lot of comfort in this pause.
We should give Neil a little bit of a high five and a hat tip, because before Trump came out and announced this plan, Neil had a note out that said exactly what they should do. It makes more sense. Start with a 10% universal baseline tariff. Check. That's what they did. Work on bilateral deals on country-by-country basis and starting the process for 232. Check. That seems to be what they're doing. Starting from a ceiling and working backward. That is what they're doing now. And this was actually the plan the Treasury Secretary set forth moments after Trump announced Liberation Day with that huge chart. He said, actually, this is going to be a cap. Don't retaliate, and we will do deals with you.
So we've got bank earnings tomorrow morning. Kicks off with JPMorgan. I don't think this makes it any easier. I don't think it makes things any clearer. How can they offer guidance in a moment like this one? It's a 90-day pause, and that's all it is.
I mean, this is the reason why a lot of people are just darn frustrated, because how do you come up with anything? The fact that Goldman Sachs retracted their recession call yesterday after the 90-day pause, again, what we just got was taking the worst-case scenario off the table. Maybe. Taking the temperature down. Does that really remove the threat? And this is the reason why earnings are going to be interesting, not only for what they say, but also the reaction of markets.
A major move on stocks yesterday, the biggest one-day pop on the S&P 500 since 2008. This morning, equity futures lower by more than 1 percentage point. Up next, Amrita of Energy Aspects saying crude could trade under $50 a barrel. Live from New York, you're watching Bloomberg TV. What a phenomenally wild few days in financial markets worldwide. Equity futures this morning down by 1.5% on the S&P 500. The S&P trading like a penny stock in yesterday's session. Check out this range on S&P 500 futures. At the highs, plus 10%. At the lows, negative 3%. A 13 percentage point range intraday on S&P 500 futures. Just absolutely mental. Danny Berger, chaos. Danny Berger has your morning movers this morning. Good morning, Danny.
Unfortunately, John, I've got another big company for you that is trading like a penny stock. So add this to the headache of market participants. U.S. Steel dropping nearly 12% in this morning's session. This coming after President Trump late yesterday saying that he doesn't want a Japanese owner for U.S. Steel, of course referring to Nippon Steel, which has been trying to take over this company. Part of the reason we're seeing such a big reaction is there was a lot of hope built up to start the week. On Monday, Trump ordered a national security review of this deal, sending shares their highest since 2024 with hopes, hey, maybe this will actually happen. Maybe now this is finally the time we can stop talking about this deal. Also on the move to the downside this morning is Constellation Brands. This is the maker of the beer Corona, along with other brands. It was lower in the pre-market session. It has now moved to unchanged, it would appear. They had their earnings. And again, you see the impact of a consumer company that was already struggling, plus tariffs. Yes, we don't have the dramatic tariffs on Canada and Mexico, but there's still a 25% tariff if you're importing beer cans into the U.S. Constellation Brands pointing out that and changing consumer behavior for giving a dim outlook. The last mover for you, this one just starting to be on the move. It is Disney. It was unchanged, starts to fall 2.6% after the headline that China would reduce some of the U.S. films coming into the country. This, of course, has a direct impact on Disney, which produces films that go into China. Just looking at their financial statements, about 10% in fiscal 2024 of their revenue came from Asia Pacific. So that would indeed be a hit if it starts to get pared back. John.
Danny, thank you. Great work. More from Danny later on this hour. On our radar this morning, President Donald Trump announcing a 90-day tariff pause on most trading partners. The move coming roughly 13 hours after higher tariffs took effect. At the same time, Trump also raising duties on China to 125%. Just finding out what Europe's official response will be from the European Commission President Ursula von der Leyen, saying, we took note of the announcement by President Trump. We want to give negotiations a chance while finalising the adoption of the EU countermeasures that saw strong support from our member states. We will put them on hold for 90 days. If negotiations are not satisfactory, our countermeasures will kick in.
So here's the start of the negotiations really between Brussels and Washington. 90 days. Can they get to some sort of framework to get to the bottom of a deal? What I would take note in a lot of this is the fact that President Trump gave them an olive branch. They're coming back with an olive branch. But what does this mean in terms of the uncertainty in the market? It still remains, at least for the next 90 days, because if Trump doesn't get what he wants, who's to say he doesn't come back with a vengeance when it comes to Brussels?
If you want that supply-side response, you've got to know what the rules are. 5 years out, 10 years out, 15 years out. And if you keep getting told that there is a 90-day pause for negotiations, those plans to build the factory in the United States are going to be on hold, perhaps indefinitely.
Absolutely, because why would you spend any capital when you don't know the rules of the game? Which is probably why this cannot extend longer than 90 days. I'm sure there's a tremendous amount of advisors. I know the president has been taking phone calls. Susie Wiles has been taking phone calls from executives. And I'm sure they're telling him this is the problem with not having clarity. So I think a lot of these executives are pushing him to get to an agreement by the end of the 90 days. But with Trump and trade, you might see 2 steps forward, 1 step back.
Waiting to see the reaction from China. China's top leaders said to meet today to discuss additional economic stimulus. Sources telling us here at Bloomberg the meeting will focus on support measures for housing, consumer spending and, Lisa, technological innovation.
This is the tricky place that China is in. As much as everyone is talking a hard line, there is some sort of incentive to come together. And one thing that we've seen from Goldman Sachs, from Bloomberg Economics, they've been downgrading their expectations to Chinese growth. This will be a hit to them at a time where so many U.S. factories produce in China. Remember with Shein, however you say it, they actually prevented them from exporting jobs overseas and said, we will arrest you and we will make sure that you get fired if you do that. So there clearly is more tension under the surface in China.
How are companies responding? So here's the latest from Walmart. Apparently asking a factory in China to leave price stickers off Christmas ornaments for the first time in 10 years. The change comes as the company continues to navigate tariff uncertainty. That's the challenge many companies face. And at the moment, this is something that Mohamed El-Erian has warned about repeatedly.
What I find interesting, though, is that when it comes to China, Trump suggested yesterday that this number, this rate of 125%, that's going to be the top when it comes to how high he's willing to go in that tariff rate on China. And then he said, I can't imagine it. I can't go any higher. He did say that we calculate it very carefully. I think there's a lot of criticism towards how they actually got to these calculations. And then he said something interesting. He said, at some point, we're going to get a call. He is waiting for Xi Jinping to pick up the phone and call the Oval Office.
And he hasn't done it yet. And we've heard that from the president repeatedly over the past few weeks. Let's turn to commodities. Crude is lower this morning by 2% on Brent to 64, on WTI to $60.91. Oil still flirting with $60 a barrel as trade tensions between the US and China continue to escalate. Amrita Sen of Energy Aspects writing, Trump needs higher supplies to lower oil prices in a manner that can provide a tailwind for global growth as an offset to his tariff policies. Instead, tariffs will lead to lower oil prices by hurting demand growth. Amrita joins us now for more. Amrita, welcome to the programme. You made some headlines in the past few days on some very, very low numbers in the crude market. So what are you expecting now?
Well, I think the prices, or the general trajectory is still lower. I know there's been a 90-day pause. We saw a little bit of a bounce. But ultimately, if you look at the trade-weighted tariffs, reciprocal tariffs globally, on the 2nd of April, it was actually 19.1%. Yesterday, it was 26.2%, despite the pause, because of just how much the China bit has escalated. It just tells you that that is ultimately the one that matters the most when it comes to kind of global growth. Of course, it's better news for some of the countries. Some of those tariffs have been paused, but like you guys were saying just now as well, there is definitely no certainty that they will remain off. We are hearing more and more from our clients that consumer and particularly business sentiment has completely come to a stall. Nobody's investing. There's no capex investment. And we're going to see a pretty big demand hit. We've just reduced our oil demand number for the second half of the year by 450,000 barrels per day, the same for 2026. So I just don't see how oil prices are going to start moving higher anytime soon until we see the supply response.
How low are we talking, Amrita, do you think oil prices can go?
So look, the difference now versus in the past cycles is that the shale break-evens are higher. And when I was there just last week as well, I would say my biggest takeaway was that outside of the Permian, all the other basins, you're talking about like in the 60s, well into the high 60s in some basins, which are now their break-evens. In the Permian, it's in the 50s. But that is effectively the floor. The difference is it's the timing of it, right? We need to be here for one whole quarter before supply response. And the response will be significant this time around. You are going to lose a few 100,000 barrels per day pretty quickly. But it is just that timing. Like in that, within that time frame, prices can continue to go lower. Remember, there's positioning driven. A lot of this is positioning driven, and people are just liquidating positions. So then it just becomes a number. But ultimately, the floor should be around where we are now, maybe a couple of dollars lower. But I don't necessarily see sustained prices in the 40s or the 50s. But we can absolutely test the 4 handle in the short term.
I know that OPEC Plus and Saudi Arabia says they do not target price. But given this environment you're describing, why did they go further and add even more barrels to the market?
Yeah, I mean, look, the timing of it has obviously led to plenty of rumors about, like, you know, were they doing this on the back of tariffs or to appease President Trump ahead of his visit to the kingdom. In reality, OPEC just has its own timelines for doing things. The Saudi OSP always comes out around the 5th of the month, so they had to take the decision before that. So it was an unfortunate timing, but the decision was entirely to do with internal OPEC dynamics. As we've been saying, you know, we have seen laggards, a couple of, you know, OPEC as in Middle Eastern countries itself, but it's mainly Kazakhstan. If you look at Kazakhstan's production, 400,000 barrels per day higher than where they are meant to be. And they are just not showing any signs of coming off. And I think that is where I worry, even for next month, regardless of price. Because if this is about getting cohesion and getting the message across that everybody needs to do their bit, then it will not matter until and unless Prince Abdulaziz sees that compliance number pick up.
Amrita, let's put that into English. Basically, this is all designed to punish Kazakhstan with lower oil prices for a margin grab unless they are into compliance, and then there can be some sort of agreement.
Yes, I think long story short, that's it. And not just Kazakhstan, the few of the laggards. But yes, it's to say the cuts need to be equitable. It can't just be Saudi Arabia that carries the cuts for everybody.
At a certain point, there's also a knock-on effect that this potentially could become punitive at that kind of level for U.S. shale producers, for the U.S. oil export system that has been one of the drivers of a lot of growth that we've seen in the United States and the GDP here for the past decade. I'm just wondering at what point that factors in as well.
Mm-hmm. Well, that's what I was saying just now, right? The shale break-evens are significantly higher now, which is why I was saying that I don't see prices sustainably going below 55 to 60 or even 65. But in the short term, it could be, because even at these price levels, we are hearing from our shale producer clients that they have just stopped drilling, or they're planning to stop drilling. They could even drop rigs. You're going to see a very significant turn down in shale production very quickly. And like you said, that has, and we forget this, we tend to talk about the U.S. as a consumer nation. Production, and given how much U.S. production is a huge part of U.S. GDP right now.
Amrita, just quickly, we've seen commodities drop across the board over the past week or so. Seems some evidence that, particularly with copper, Chinese buyers might be stepping back in. Ahead of stimulus, are you seeing anything like that with crude?
We've seen a little bit here and there, but I do think right now there's just a bit more panic because it's still a moving target. They have come out with an SPR program as well, saying that we need to stockpile, but that's really from July onwards. The biggest hit is actually going to be on LPG, ethane in particular, and propane. Crude's still okay, but the physical market is actually still very strong. Even in the East, it's, stocks are still drawing, but it is really about the fear of the future.
Got it. Amrita, appreciate the update. Thank you. Amrita Sen there of Energy Aspects. Quick update on prices for you. We're down 2% on Brent, 2.3% on WTI, $60 and about 94 cents on WTI crude. Brent crude this morning, $64 unchanged. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The EU will pause counter tariffs on U.S. metals for 90 days. Sources tell us the bloc is weighing a proposal where it would move forward with tariffs on around $23 billion of U.S. goods, but then immediately suspend them. EU Commission President Ursula von der Leyen saying this morning that she wants to give talks a chance. Goldman Sachs has rescinded its recession forecast in the space of just a few hours' time after its initial call. The reversal came after President Trump announced a 90-day pause on most tariffs, and as there still see policy uncertainty leading to a sharp economic slowdown this year and 45% odds of a recession in the next 12 months. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny later on in the next hour. Up next on the programme, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful.
It's beautiful. Subadra Rajappa of Slok joins us next, live from New York City. You're watching Bloomberg Surveillance. Futures this morning down by 1.5% on the S&P 500. On the S&P on Tuesday, a close below 5K for the first time since April 2024. By Wednesday, we closed above 5,400 with a major move higher. This morning, we take some of it back. We're down by 1.8% on the Nasdaq. Speaking of wild trading ranges, check out the bond market and look at the front end of the curve, the 2-year 388, down just 2 basis points. Look at the range yesterday. At the low 365, at the high 4.03%. A 38 basis point trading range in a single trading session. Under surveillance this morning, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. The big move wasn't what I did today. The big move was what I did on Liberation Day.
So here's the latest this morning. The president backing down from major tariffs, attempting to offer some support to a very nervy bond market. Subadra Rajappa of SocGen writing, Trump raising the pressure on all US trading partners may not bode well for their willingness to hold treasuries. Subadra joins us now for more. Subadra, good morning.
Good morning.
Is it a big, beautiful bond market this morning?
I think it still is, but the signals from the big, beautiful bond market is worth heeding to, right? Less bad is not good. If you look at the effective tariff rate, it's still around 25%. You're going to see that impact on both consumer, spending, consumer sentiment, business investment, and ultimately growth. And yes, we have kind of reduced the odds of a recession, but growth is still going to be at or close to flat for this year. Mind you, in December, in the summary of economic projections, the Fed had 2.1% growth for this year, and core PCE heading lower. Now we're looking at inflation somewhere between 3 to 4%, and very nearly flat growth. So that is not necessarily a good thing.
So still negative for growth, which should be good for bonds, but at the same time bad for trading relationships, which might be bad for bonds. So is this good or bad for bonds this morning?
I think it's still, somewhat bad for bonds. And the reason why I'm saying this is that coming into April 3rd, our expectation was that that would be the day we get certainty on tariffs. And then that stays in place for a while. People can go about their business. But guess what? It turns out that's the beginning of the volatility in bonds, not the end. So the next 90 days is going to be quite volatile in the bond market. And we're going to be looking at every news that comes in, how our trading partners respond, and that I think is going to add to a lot of volatility, and that skittishness is going to be very evident in the bond market.
The bond market will remain yippy. That's what I hear from you, that yippy is not going away. I'm curious about the auction that we saw yesterday. It was pretty hyped. People were very concerned we could see some sort of failed auction of 10-year bonds. But it was actually really successful. There was a record amount of indirect buying of these notes. What signal did you get from that, given that that came before President Trump's announcement?
It's definitely a step in the right direction, because that was really the most important data point of yesterday that I was watching to see if we'd see another tailed auction. I mean, the 3 basis points tailed auction, the 3-year on Tuesday was quite dramatic. So, if you start seeing more tailed auctions, then you start questioning the demand for treasuries. I mean, today we get a tranche of 30-year supply, and we'll have to see how the market takes that down. But that's one of many barometers that I use to gauge the demand dynamics for the treasury market, because you're looking at a trajectory for debt and deficits that's still quite dire, right? Even if we have some sort of a tax deal, you're looking at deficits going up. We could raise some revenues by way of tariffs to offset those deficits, but it's not going to be nearly as enough as people think it will be.
So what do you need to see to not be yippy? I mean, I guess, what do you need to see to feel like you're confident that U.S. bonds, U.S. treasuries could act as an offset in some sort of economic downturn?
So we did see that price action initially when you saw the rout in equities. You saw investors fly to the safety of bonds. But 10-year yields got to like 380, 390, but then it kind of moved all the way back up because the market started to view that as a sign of instability. So when you have sort of a little bit more of a crisis of confidence, if you will, then you're going to see that bias towards higher yields. And that's my concern, is that you need to see stability in the data. You need to see some level of clarity, if you will, on tariffs for this sort of volatility to subside in the bond market.
Is there a problem with subscribing a narrative to something that might be more just fundamentally liquidity driven? The fact that we haven't gotten the regulatory break to a lot of banks to hold a certain amount of treasuries, that there are certain liquidity constraints. And frankly, when you get that level of uncertainty, all buyers step back at the same time that there's a basis trade unwind. How much is this purely liquidity driven? And we can't really make too much of all of these moves.
A lot of it is liquidity driven, but when it is liquidity driven, you have to make a lot out of these moves, right? Back in 2020, in March, the entire rout in the bond market was because of a lack of liquidity, and the Fed had to step in to be that backstop provider of liquidity. So the lack of liquidity is something that's definitely a serious concern. What was also interesting to me in the price action in the last week was the fact that the haven assets were actually bonds and JGBs because that Treasury bond and JGB spread actually widened. So that leads me to believe that investors are not viewing Treasuries in the same way that they did or they used to in past crises. I mean, going back to either COVID or you look at the great financial crisis, you see that the market very quickly prices in a lot of cuts. You see a pretty dramatic rally in bonds. You saw none of that this time around. So that's something that's worth paying attention to.
Nouriel Roubini this morning is talking about how the bond, credit, and stock vigilantes ended up being the most important people in the world. What do you take in terms of this entire episode of signal we should learn from to understand potentially what Trump might do next, depending on where bond levels or stock levels are?
So I think it was wise on his part to pay attention to the signals coming from the bond market because as Lisa was pointing out, the basis trades, the unwind of any sort of unruly unwind on those basis trades, any sharp move higher in repo rates could be something that could really roil the markets. So we need to see that there's steady demand for treasuries. There's not that same level of volatility in the bond market going forward. So if anything, I think that President Trump is going to be paying more attention to the bond market because that's something, if we see more uncertainty, you're going to have to see the Fed or some other big, large backstop buyer step in to provide that liquidity.
CPI data, 8:30 Eastern Time. Are you going to hang around? Going to look at it? How useful is it?
We have CPI today?
Precisely.
So, no, the data is, of course, very, very important. We saw this sort of services side inflation coming off. But really what was interesting to me in last month's print was really the fact that you saw goods inflation starting to rise. So the sort of divergence between goods and services inflation might start to become a theme for this year. So we saw that during COVID when we had supply chain disruptions. This is sort of the same, type of event where you're going to see disruptions potentially from the supply chains reorganizing and redistributing.
Are you expecting higher prints in months to come?
It really depends on what tariffs stick, right? If there is a very high tariff regime as it stands, if we see at least 10% tariffs on all the countries and maybe 50, 60% tariffs on China when the dust settles, that's still a big number, and you should see perhaps higher inflation over the next couple of years.
Subadra, it's good to see you.
Good
As
to see
always,
you too.
a lot to figure out. Subadra Rajappa there of SocGen on a big, beautiful bond market. Yields are lower this morning on a 10-year by 5 basis points or so, around 4 now to about 4.30 on 10s. At the front end of the curve, down 2 basis points. Lisa, just wild swings at the front end of the curve and across the curve in yesterday's session.
There was this feeling, and you alluded to this earlier, that potentially it was getting dysfunctional, given these wild swings and given some of the sell-off that we saw. And there was this speculation that the Fed would have to step in. After what we heard from President Trump, now all of a sudden you have Neil Kashkari of the Minneapolis Fed saying the bar is very high right now to make any kind of move because of the uncertainty, because of tariffs. And frankly, that has made inflation and getting inflation expectations under control our primary objective before even our dual mandate.
The Federal Reserve has played this really well over the last week or so, but they're still stuck between a rock and a hard place. Downside risk to growth and upside risk to inflation. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Stuart Kaiser of Citi. We'll speak to the former Deputy Treasury Secretary Wally Adeyemo, Eric Resnick of KSL Capital Partners on the luxury hotel business, and former Kansas City Fed President Thomas Hoenig on what the next move should be for this Federal Reserve. Live from New York City this morning, following some wild swings in financial markets worldwide. Equity futures this morning down by 1.7% from New York. This is Bloomberg.
You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession.
It's the volatility, it's the uncertainty. Where are we going from here?
The scarcity in the marketplace is certainty.
Certainly the markets are challenged.
Everyone knows there's going to be pain, but the issue is they just don't know that the cure seems to be worse than the disease right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Trump blinks, but the damage isn't all undone. That's the line from UBS this morning, and it's reflected in the equity market. Live from New York City, good morning. The second hour of Bloomberg Surveillance starts right now, with equity futures on the S&P lower, and on the Nasdaq too. We're down by 1.6% on the S&P 500. On the Nasdaq, down by close to 2. On the S&P, the range on futures yesterday, positive 10%, negative 3. A 13 percentage point range on S&P 500 futures. Wild. Even wilder than that, in the bond market, major swings at the front end of the curve. The two-year yield, a 38 basis point intraday range at the front end of the curve. Yields lower by 3 basis points this morning, 387.65. Later on this morning, 90 minutes away, CPI data in America. No one's talking about it. Lisa, more inflation data just around the corner.
Yeah, no one cares. I mean, at a certain point, it's backward looking, and people are trying to understand what is the policy backdrop in a quickly moving world. It is hard to get much confidence from what happened yesterday. Yeah, you had the biggest rally on the NASDAQ going back to 2001. Yay. But there isn't a sense of exactly why or how durable this is. How much are tariffs still on? We don't even understand what the average blended tariff rate still is. There's one particular average of 27% going now down to 24%, others saying around 15%. No one can actually pinpoint what to even model at this point for the effective tariff rate at this moment.
It's super difficult. Trade's not static. And if you come up with a major tariff on China, presumably some trade will shift away from China. In the meantime, though, compare where we are now to where we were only a week ago, and tariffs are higher. They're not lower.
They are when it comes to China, 125%. That is the levy for these Chinese goods coming into the United States. You also have a 10% tariff ring around the United States. That is staying put. The issue that investors have, the market has, is the goalpost keeps changing when it comes to reciprocity for each individual trading partner. And we're not going to know where they end for another minimum 90 days.
We have revealed one thing. We've discovered that the Trump put has moved away from the Dow to the bond market based on comments just yesterday.
That, to me, was the big takeaway. The bond market's in the driver's seat. It was yippee. He actually responded. What is the strike price of that, though? Is it just almost getting to a dysfunctional place where the Fed would have to step in? Does it mean that Scott Bessent now has the ear of the president? What's to say that it's not going to be Peter Navarro tomorrow? There is this question of how much can you rely on something that seems to be driven more by impulse and intuition rather than some sort of formulaic policy.
The Treasury Secretary said yesterday outside the White House that he had a conversation. They all had a conversation on Sunday. And on Sunday, what happened? On the way back to Washington, D.C. on Air Force One, who is standing behind the president? I peeked my head out. It's Scott Bessent, the Treasury Secretary. On the way down to Palm Beach, it was Howard Lutnick. It does feel like this idea is really stemming from the Treasury Secretary. It is what he told me after Liberation Day. This is a cap. We can do deals coming down. And the president said this has been percolating for a few days. We decided to make the decision this morning. I was looking at the bond market overnight, and then we sat around and wrote it from what he calls their hearts.
Looking at the bond market this morning, yields are lower. We're down 3 basis points on a 10-year to 4.30. On twos, we're down 4 to 387. Coming up this hour, Stuart Kaiser of Citi as stocks stage another historic bounce. Former Deputy Treasury Secretary Wally Adeyemo as President Trump's U-turn isolates China, and former Kansas City Fed President Thomas Hoenig as Fed officials signal they'll stay on hold. We begin this hour with stocks lower following their biggest one-day climb since 2008. Stuart Kaiser of Citi staying cautious, writing, "We shift to a neutral footing on U.S. equity risk as 2/3 of the dip buying conditions were fulfilled by a 90-day tariff pause. We are not necessarily comfortable with long equity exposure and expect continued headline volatility." Stuart joins us for more. Stu, good morning.
Good morning.
Wow. OK, so this is what we've got. 10% baseline tariff and then something north of 100% on China. Good or bad?
As you said, worse than last week, probably better than Sunday night as a blended, type thing. I think basically what the market is telling you now is they sort of took some of the tail out of the tariff risk. And we're going to need to see successful and observable negotiation progress over the course of actually probably the next couple 2 to 4 weeks, without the market to react negatively.
It doesn't sound like you've got too much confidence that this is over.
No, I mean, look, even if you just, to Lisa's point, we don't know what the blended tariff rate is. At steady state now, to your point, is much worse than it was last week. And we have not really gone very far to pricing in the knock-on recession risks if the current tariffs are held in place. I'm also of the view there's probably less than 3 people in the world that know exactly, what the future looks like on this front. So just a tremendous amount of uncertainty there. So, yeah, we're still pretty cautious, though. To be fair, I think in instituting this delay does trim some of your like worst case tail risks off, which is why we're kind of a little more neutral than I think we were extremely cautious over the weekend. We're kind of more neutralish now.
Can you take us into some of your conversations with clients recently to give us a sense of what the flavor has been like, what the tenor of them has been, and what you say?
Look, I think honestly, as many opinions as are around the table is what we're getting from clients. I would say, look, the outlook has been very, very bearish on U.S. equities. You see that in positioning, you see that in flows, you see that in our conversations where it's, maybe the view was, hey, I don't know, the plurality of outcomes is you get a negotiated deal and it's better than worst case. But there is this situation where if you took your tariff hit and you threw a decent sized recession on top of that, you get S&P earnings down to $200 or below, and you put some reasonable multiple on that, and the number doesn't look as big as you would like it to. I think is the best way to put it.
3,600,
so,
right?
Yeah, you could be, 4,000 or below with, reasonably conservative math. So I think a lot of folks were saying, even if I wanted to buy this dip, I can't fully discount, that negative there, because if you think of that number as, let's say that's your recessionary outcome. Well, what are your recession odds? If your recession odds are anywhere near 50-50, now you have a 1 in 2 chance of an outcome that looks really poor. So I think investors were respective of that and were just very, very cautious about putting risk back on. And the fact is, we've had 2 of these 5% rallies, over the last week. They lasted about 15 minutes. So it wasn't like, as an investor, you had the opportunity to catch those, really. You either happened to have the risk on or you didn't. And I think that's been equally frustrating, that I suffered all the way down. The market rallied, 6% in 15 or 20 minutes yesterday. You didn't get a chance to engage in that.
Have you noticed a difference in tone between domestic investors and international investors?
A little bit. I think in a lot of these cases, when you have domestic policy issues, the domestic investors tend to be more bearish, than the international investors are. In this case, I think it's shades of gray, because the international investor is also very frustrated. If you're up in Canada meeting with those investors, they're not feeling so great either. And I think the same is in Europe. But I think U.S. investors probably incrementally a little bit more negative than the international folks, just because we're so close to it. But again, it's going to be hard to find a bullish or optimistic investor right now.
If these markets were Chinese, wouldn't we be calling them uninvestable?
I wouldn't, but you you might be.
I'm asking the question right now how investable this market is, given these wild swings.
No, I think it's not particularly. And I think you saw that actually on Monday, where you had that, very sharp squeeze in the morning. And then after that, you got some negative China headlines on tariffs. Shorts did not really aggressively lean back into that. And I think it was because you got so hurt in that sort of flash rally that you didn't have confidence, to put the risk on in the other direction. And I think what you're seeing overnight is a little bit of that, where the market rallies so quickly higher. Sponsoring the next leg of that feels really poor risk reward. And I think you're seeing that a little bit overnight. So yeah, it's from a tactical perspective, it does feel, very, very hard to invest in. I won't call it uninvestable, but very hard to invest in. And, even from a long-term investment perspective, it's really hard to handicap stuff, and you're probably thinking, I might get a better entry point here to begin with.
Things have been really brutal. You've set up the next month or so. We need to set up the next 90 days. What these negotiations are going to look like over the next 3 months.
And trade deals normally take 2, 3, 4 years, and they're trying to get stuff done in the matter of 90 days or maybe a little bit more, a few months. What I would take from everything Donald Trump has said, on the campaign trail, he promised 10% tariffing around the United States, 60% on China. We know that he goes into everything with a maximalist approach. Well, maybe the China is going to come down. That tariff rate will come down to 60%, and we might end up exactly where he planned on starting, but just going through a lot of emotions to get there.
In the meantime, we're going to be looking at uncertainty, negotiations, and more uncertainty. And Stu, I've got to ask you how you and the team will be navigating the incoming data. We just caught up with SocGen Subadra Rajappa, who said CPI, what's CPI? 8:30 Eastern time, there's an inflation report. There is. How are you navigating the data? How will this market respond to incoming information?
Look, CPI, look back to payrolls last week, they probably felt like the forgotten child a little bit. I think the data we're getting last week and this week is much more what was the state of the economy coming into this. And if you got a strong enough labor market report where at least it was, okay, the economy was solid before I put these tariffs on. If you had gotten a weak payrolls report and then added tariffs, that would have been incrementally negative. I think that today's data is going to be interesting because the last inflation report, the data was actually pretty good. The market traded down because they treated that softer inflation as weaker demand. So the data today is going to be really interesting. If the data prints hot, it's going to be, oh my God, we had an inflation impulse before tariffs. If it's light, it's going to be, oh, maybe the demand's getting destroyed already. So it's hard to see actually a positive outcome from the inflation report today, but luckily it might get ignored. So I guess we don't have to worry about it.
Will earnings get ignored? Because right now it's very hard to really trade on the guidance that also seems a bit, I don't know, unreliable as well.
Earnings, I think, are going to be all over the place because if you're a company, you either have to defend numbers, and boy, you better have a good story about why you're defending them. You say, I don't know. Frankly, I don't think that's going to be rewarded as an answer. Or you kind of throw in the towel a little bit, which I think we talked about a month ago. And that side of it, I think if you kind of throw in the towel and your stock is washed out enough, that might help you. But again, none of those three outcomes are good. Broadcom the other day announced a buyback. It wouldn't surprise me if you get some guidance maybe pulled or widened, but then some buybacks announced behind it to kind of support the stuff. But yeah, it's going to be a very, very interesting earnings season.
Stu, it's good to see you. Thanks for breaking it down. What a couple of days. We all need some rest. Stuart Kaiser there of Citi. Your equity market on the S&P 500 negative by 1.7% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. House Speaker Mike Johnson has canceled a vote on the Senate's budget resolution last night, with fiscal hawks saying it would add too much to the nation's debt. The House and Senate need to adopt identical versions before they can move on Trump's domestic agenda, led by a $5 trillion extension of his expiring 2017 tax cuts. Elsewhere, U.S. Supreme Court Chief Justice John Roberts let President Trump temporarily fire top officials at two independent agencies while the High Court decides how to handle presidential power. The case tests a 1935 ruling that let Congress shield high-ranking officials from being fired. The decision could determine whether Trump has the power to fire Fed Chair Jay Powell. And Amazon CEO Andy Jassy out with his annual shareholder letter, writing that the company has to act like the world's largest startup in order to meet demand for AI and trim its bureaucracy. Jassy said that Amazon will continue to invest heavily in AI alongside forays into healthcare, including Amazon Pharmacy. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the program, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people. They're in the process of figuring it out, but they want to make a deal.
Up next on the program, the former Deputy Treasury Secretary Wally Adeyemo, live from New York City this morning. Good morning. Equities this morning lower across the board on the S&P 500, negative at the moment by 1.8%, down 2 on the Nasdaq 100. Under surveillance this morning, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
So here's the latest this morning. President Trump isolating China as the primary target of his trade offensive, hiking tariffs to a record 125%. China's top leaders set to discuss additional economic stimulus later on today. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, what's the state of play this morning?
Yeah, hey, John. Well, you heard President Trump there signaling optimism that there could be a potential deal with China. He said that once Beijing calls, they'll be, quote, off to the races. The only thing is that per our current knowledge is it appears Beijing hasn't called. And as you've been reporting this morning, there was that apparent escalation with China announcing those potential curbs when it comes to imports of U.S. films into the country. President Trump did say yesterday, though, that he couldn't imagine raising that tariff, that 125% levy, any higher when it does come to Beijing. Now, when it comes to the other countries, Treasury Secretary Scott Bessent has said that this was all part of the plan all along. It shows that the U.S. wants to negotiate in good faith. But Bloomberg Economics writing that these whipsaw movements do very little to quell any of the record high uncertainty that we are seeing, not to mention that companies have been really hitting the pause button of their own as they try to discern if any deals can actually get done in this 90-day timeline. Now, Bessent has confirmed that he has meetings on the books already with Vietnam, South Korea, Japan, and India as we try to see if any deals can be done there. But the big question is, what does it take to actually clinch something in such a short amount of time? John, the Commerce Secretary yesterday did give us some further hints to things that we've already been tracking. He said that the U.S. has been rather intrigued by the concessions these countries have been putting on the table, particularly when it comes to those non-tariff barriers.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. I think we're all just totally desensitized. You wake up, see futures down 1.8%, just kind of shrug your shoulders. Big deal. What's 1.8% these days? Extending the conversation now. Joining us around the table, the former Deputy Treasury Secretary under President Biden, Wally Adeyemo. Wally, good morning.
Good morning.
How good does it feel to be on the other side?
It feels really good to be on the other side at the moment.
What do you make of what you've seen down in Washington so far? Give us your opinion on things.
I do think that everyone agrees with the president that we need to do more advanced manufacturing in the United States, and tariffs can be a tool. But as the markets have shown us over the last few days, broad-based tariffs ultimately are going to cause pain for American businesses, but also American consumers. And I think that everyone was encouraged, and that's why we saw the relief rally when the president paused. But the important thing is a pause is not a stop. And you still end up in a place where you have 10% tariffs across the board and 125% tariffs on China. And that's going to mean that Americans are going to pay more for groceries, they're going to pay more for housing, and our companies, especially small businesses, have uncertainty because what's going to happen in 90 days. But the thing the president has said that I think is encouraging is that he's open to negotiating, and the goal now is for him to define what does he want to accomplish in these negotiations, and hopefully for those things to happen very quickly.
But trade deals take years. You've been in the rooms with all of these counterparts. Do you think they get deals done in 90 days?
It's really hard to get a trade deal done. We negotiated a deal with the Japanese over critical minerals as part of the IRA, and that happened relatively fast because both sides wanted to get to an agreement. And the hope here is that over the next 90 days, the administration can accomplish three things. One, lower tariff barriers for the United States so our companies can compete level playing field, and non-tariff barriers as well. And then the third piece is also important because what we found was after President Trump cut his first deal with the Chinese companies moved to Vietnam and Malaysia. So the question now becomes, when you're cutting a deal with these other countries, can you get them to put in place restrictions so the Chinese firms can't take advantage of their economies to ship things to the United States? But even more importantly, when you think about what's going to happen now that China has these huge tariffs on them, they need to sell their things, and they're going to sell them to Southeast Asia, they're going to sell them to Europe. So now they need to think about, do you need to put safeguards in place to make sure that Chinese overcapacity doesn't overtake our shores? And that's where you have the opportunity potentially to partner with some of these countries to confront China. And my hope is that the president and the secretaries he's appointed to do this work with our allies and partners to confront the Chinese.
Recently in The Economist, you wrote that the global trading system needs new rules, not tariffs. Is this what you're talking about? Basically more bilateral rules and then taking the friends along for the ride to confront Beijing?
It's critically important because what we've seen is that if you care about our steel industry, preventing Chinese steel from getting to the United States doesn't mean the price is going to be lower if they're selling that steel to the rest of the world. So we've got to work with the rest of the world if we want to put our companies on a level playing field. We all agree that we should do more advanced manufacturing in the United States, but the U.S. is 4% of the world in terms of population. We want to make sure that Ford cars, our steel, we can sell it in other parts of the world, which represents 96% of the population. And if we're not willing to work with those countries, it's going to be really hard for our companies and our workers to be open to those markets.
When it comes to the end goal, you actually sound a lot like a Trump official, even though you were part of the Biden administration. But the Biden administration used subsidies, industrial subsidies in the United States to try to cajole business to do work here. Do you think Trump is right to use this carrot and stick approach as well?
I think the key thing to remember is that we did do things like the CHIPS and Science Act, where we provided companies with funding to help them build in the country. And it wasn't just about the manufacturing jobs, it was about the entire ecosystem. But we did also strategically use tariffs, because the key thing you have to do is an all of the above strategy. Ultimately, you have to give incentives to companies to build here, but to create really good paying jobs. But when a country is unwilling to create a level playing field for you, for example, China, sometimes you have to use tariffs strategically. The problem is when you do broad-based tariffs, you get into a situation where it hurts American consumers, farmers, and also our businesses more than sometimes it hurts the other country. Ultimately, the hope is that when you get into negotiations, we're able to pull back some of these tariffs, with the idea being that if you can reach an agreement, where you end up with is fewer tariff barriers for American companies, because I think the thing that you believe across the aisle in D.C. today is that if American companies are given the ability to compete on a level playing field, our companies and our workers are going to do well. The key now is how do you get there?
Given your negotiations with international partners, do you think that there is legitimacy to this feeling that maybe some of the other nations who used to be our trading partners are going to get closer to China, not further away, as a result of some of the tariff turmoil?
My view is that the United States still has an incredibly good hand, but it matters how we play it. And over the next 90 days, we have the ability to work with our other countries to build a coalition by getting them to reduce tariff barriers and non-tariff barriers. But we also have to remember that the U.S. has tariffs on their economies too. So, for example, we have tariffs that protect certain industries here. Are we going to be willing to lower them as well as part of this process? And then what we have to remember for all of us is that Chinese overcapacity is not a problem just here in the United States. It's a problem in Southeast Asia, it's a problem in Europe, and we have to be able to work together to solve it, because if we take a unilateral approach, ultimately that overcapacity is going to wash up on the shores of other countries.
Why aren't Democrats coming out and saying that Donald Trump's goals are the right way to go, that actually this is correct, it's just that we disagree with the measure?
I think that what you heard from Governor Whitmore yesterday was exactly that, which was that we think that we should have more manufacturing in the country. We can use tariffs, but ultimately the problem is that it can't be the only tool. You can't do it in a broad-based way. What are you doing to create incentives for businesses to build advanced manufacturing in the United States and to create good jobs is going to be just as important as how you strategically use tariffs. The challenge we have today is that for American people, when they go to the grocery store, when they go and try and buy a house, prices are going to go up, but their incomes haven't. If you're a small business today and you're thinking about your supply chain, how are you going to buy the things you need to be able to get things to your customers? That's harder today than it was a week ago. And if you're a big business thinking about earnings season, how do you give forward guidance in a world where you have a 90-day pause? And I think ultimately we agree that we need to have more manufacturing in the country. And I think that Democrats and Republicans can work together to accomplish that. Tariffs should play a role, but it has to be an all-of-the-above strategy that includes how do we create the right incentives here in the United States as well.
Wally, can we just finish on what I'll call the European problem? Why is it so difficult to get the Europeans on side with US policy? Why is that so hard?
I think Kissinger put it well in terms of Europe is not a country, it's a jurisdiction, and there are a number of different countries there, and it takes them time to get to the right place. But the reality is that we'd rather the Europeans be arguing with each other over politics than what happened before we had the European Union. And fundamentally, Europe has been an ally, but we have to hold Europe accountable as well to being in a place where they create a level playing field for American firms as well. And in doing that, it's going to be not only good for the United States, but it's ultimately good for Europe, frankly, because Europe needs to grow. Their economy has been stagnant for too long. And without a partner like the United States that can help drive that growth, it's going to be really hard for Europe to compete with China and compete in Asia. So ultimately, the goal here has to be to reach an agreement that will be good for the United States, that will mean that the United States is in a better position to manufacture things, but ultimately needs to be good for Europe too, because overcapacity from China is a serious problem that is ruining Europe's industrial base as well. So there is room here for a deal. The key is to make sure that both sides get into the same room and think about ways in which we can grow the global economy and Europe and the United States economy.
Wally, tremendously smart, as always. It's good to see you. We've missed you. Let's catch up again soon. We need to talk taxes. Former Deputy Treasury Secretary Wally Adeyemo. Up next on the programme, Resnick of KSL Capital Partners as tariffs weigh on global travel. From New York City, this is Bloomberg. 60 minutes away from the CPI report, equity futures are negative and near session lows. We're down 1.7% on the S&P 500. 2 hours away from the opening bell. With your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. It's the deal that refuses to go away. U.S. steel share prices falling nearly 10% this morning. President Donald Trump saying that he does not want to see a Japanese owner for this company. The reason it's moving so much on that, is the fact that there had been hopes to start the week that maybe this deal would go through, with Trump ordering a review of the deal. He has said, Nippon Steel, you can get creative, but he's been advocating for something of a minority stake, not a majority stake. Also on the move this morning, we had earnings from CarMax, another sort of case study in how you address the macro uncertainty. They've removed their timeline for long-term goals, saying we're still keeping those long-term goals, but we don't know exactly when we're going to get there. The interesting thing is, if you look through the earnings report, they don't talk about tariffs, they don't talk about trade. It's literally business as usual, except for one little line that says broader macro uncertainty. That's what they're attributing to. But of course, used car prices very impacted by tariffs, considering new used car prices are likely to move higher. Those shares down by more than 7.5%. Wrapping up with Dell, another case study for you. This and what happens when component prices go up. A Bloomberg study of their website shows that they have removed countless discounts on their products. It appears that Dell indeed will be charging consumers more when the component prices go up. The company did not respond to that study from Bloomberg, but the CFO did say earlier this year that they plan to pass prices on. Those shares down more than 2.5%, John.
Hey, Danny, thank you. Appreciate it. Danny was talking about this a little bit earlier, exemptions. How many exemptions will we see for big tech? And I'm thinking almost exclusively of Apple at the moment. How many exemptions will we see in the weeks to come?
Well, there's certainly all these companies are lining up and they're asking for these exemptions, these carve-outs. You saw exemptions and you saw carve-outs in the first Trump administration. And then Trump yesterday pretty much signaled that he's open to it depending on what it is and what the company is. So I think if you make your case to the president, you likely are going to get one.
Futures down this morning on the Nasdaq by 2%. On our radar this morning, President Donald Trump pausing tariffs on most global trading partners for 90 days, but raising levies on China to 125%. The U-turn coming roughly 13 hours after duties on 56 nations and the EU took effect.
So obviously the Trump administration is coming out, Caroline Leavitt saying this is art of the deal. We all missed it when it comes to what the president was doing. I think maybe it's a bit of both. We know that the president likes to start out from a maximalist position. At the end of the day, he wants to get deals done. At the same time, this did happen at a time when you saw some unraveling in the bond market. That certainly got the attention of the Treasury Secretary Scott Bessent, who on Sunday, after an interview with the American media, went down to Mar-a-Lago, clearly had a meeting with the president, and then they came back to Washington, D.C. together. So how this played out, I'm not actually surprised about. The question now is uncertainty remains. Who gets the deals first?
Certainly felt like the bond market had a key role to play in all of this. This was the president's quote just from yesterday, Lisa. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. But I saw last night where people were getting a little queasy, and maybe he was getting queasy too.
It shows just how much the bond market is the ultimate constraint right now on a president who is looking to reduce borrowing costs, and he's a debt king. He loves debt. He could see the disruptions that were happening in the market. Key question is how long this will last, what kind of level he's targeting, and do we have a better understanding of a strike price, or is it just simply that level of volatility that could potentially invite the Federal Reserve to have to intervene because of market dysfunction that could potentially get his attention?
So we've got lots of talks coming up and a 90-day pause. Is a 90-day pause realistic? Is that long enough, a decent time frame to get a lot of this stuff sorted out?
To be honest, I didn't think it was. Maybe when you're talking about a comprehensive bilateral trade agreement, it's not. But what did Wally Adeyemo, who's the former Deputy Treasury Secretary, say just now? There was an impetus and a need to get a critical mineral deal done with Japan, and they got it done very quickly. So when you have two parties that want to get to an end game as quickly as possible, then potentially they can get at least some of these, a handful of these deals done within 90 days.
Speaking of Japan, the president also had some comments on U.S. steel. He doesn't want to see U.S. steel owned by a Japanese company. Trump pointing to the steel producers' rising orders as evidence that it doesn't need outside investment. And on Monday, ordering another national security review of Nippon's proposed takeover.
So I think his comments are really interesting because on Monday, what individuals took from that memorandum and that new order he gave for CFIUS is that potentially that he would amend the decision by the Biden administration and the predecessor to block this $14 billion transaction. Now what he's saying is CFIUS is going to look at it, but I still don't want it to be U.S. owned. Potentially, though, on the margins, there's a way to get a deal done. And it'd still be an American-owned, maybe just more money coming in, a bigger just investment, not a full takeover. Remains to be seen.
Watch this space. So at the moment for companies, it's a tricky moment. How much guidance can you actually provide for 2025? Delta Airlines pulling full-year guidance, warning of uncertainty in global trade. The caution comes for what is expected to be a resilient 2025, according to travel and leisure investor KSL Capital Partners. The CEO and co-founder, Eric Resnick, joins us now for more. Eric, good morning. Good to see you.
Good to see you. It's great
What does this mean for you and your investments? What changes for you in the last week or so?
I don't think anything changes today. If anything, I think with all the stress in the markets, people need a vacation even more than ever.
Amen.
Are you offering a discount? That's what everyone wants to know.
No discounts. No, we can't bribe the media. But we're happy to arrange bookings for you, though. I think, in all seriousness, we've been investing behind the trend towards experiential travel, especially amongst the mass affluent consumer, for 30 years. We've invested through, half a dozen different downturns at this point with different sources of volatility. While certainly we're on our toes, we're alert, we're paying a lot of attention to what's going on in the markets and the discussions that are happening, it doesn't change anything that we're doing today. We're about having great assets, great businesses, providing a unique experience for our customers and guests. And so if we can deliver on that, I think we do well in the long term. In the short term, there's disruption. Uncertainty isn't good for anybody, but we like to think in that disruption there can be investment opportunity.
Well, that's what I was going to ask you. Is this dislocation a sort of golden opportunity for you after having just raised a new fund? Is it something that you want to get really active in? Or do you think that right now there's sort of a new level of uncertainty permeating some of the disruptions?
Well, this is a little different, right? I mean, every downturn you have is always a little different. I don't know whether this will be a blip or something significant when you look back, in 6 months and we have more data. We just closed on our Tactical Opportunities Fund number 2 last night at its hard cap, and we're grateful for the investor support in that because I think they see what you're referencing, Lisa, that there is an opportunity to step into the breach if there are some companies out there that maybe don't want to sell but need capital, and that's what our special situations or tactical opportunity strategy does, is we provide partnership capital to those businesses. Our main equity fund, which invests in control positions in businesses, we've had a quiet time on the acquisition side over the last 2 years, really, since inflation reared its head and rates came up and there were those challenges. But we've seen that thaw gradually happening, and actually we have a really strong pipeline right now. How that pipeline materializes in the wake of what's gone on in the last week, that remains to be seen. But we're looking very closely at the data to see whether or not there is any sign of the consumer weakening in any way.
So let's talk about that. Given that the wealthiest consumer has really driven the American economy over the past couple of years, and it's been driven by the wealth effect, driven by what we've seen in equities, is there any sign, even if people aren't withdrawing bookings, that maybe they're not going for the most luxurious of luxury options out there?
Right now, we're looking for that because we are asked that, and we understand the logic behind the question. But right now, we're seeing a message of resiliency. But it's too early, I think, to extrapolate from the data. We're up about 10% in bookings for the current year, and we have seen that number drift down a little bit since the beginning of the year. I mean, maybe we started off at 12 to 13, and now we're 3-4 points behind that, but still up healthily. Over where we were at the same time last year. I was eagerly awaiting our booking data from last week to see what happened the week of these announcements. And I was a little bit surprised, and it's one data point, it's 1 week of data. We were actually up 15% in bookings last week, which I wouldn't have expected that. I don't think that's because people rush to make vacations. I think that's idiosyncratic.
It depends. Last week was a week.
But certainly the data could have said we were down 20, and I would have been telling you people naturally pause when there was such a news cycle, right? That didn't seem to happen. Will that happen? We'll see.
There are trends within the trends, though. This question of whether U.S. consumers are still going to go to Italy.
Yeah.
I mean, some of them will, but not all of them in the same kind of way, especially if there's a weaker dollar and a stronger euro. Whether international consumers are going to be coming to U.S. resorts in the same kind of way. Have you seen any changes in that?
The one data point that you can look at and say it is different is, and there has been a little more time on this one, is Canada. We have seen a pretty dramatic reduction in the Canadian demand to the U.S. Now, example, Hawaii, right, which is a meaningful destination for Canadians, Palm Springs. We've seen kind of double-digit reductions in demand already from Canadians, saying, you know what, we can take our dollars elsewhere. And so that is something that concerns us. Now, Canada is a relatively small proportion of the total business in those markets, but that we think is statistically significant because that's been happening for, if it's 4 or 6 weeks now. On the converse, we're up more than 20% in our bookings in Mexico and the Caribbean, from Canadians and from Americans. So it's the overall travel picture is pretty strong, but there are definitely gives and takes, and you can see that in the Canadian data.
What I'm hearing from you, Eric, is that there's going to be no deals because the bookings just keep holding up.
I hope that's true.
At any point, are there going to be any hotels, packages that have to cut prices?
We've seen pricing power be reduced, right? And the CPI data comes up today. It'll be interesting to see what that shows. But what we have seen right now is when I said bookings are up about 10% for the year, that's virtually all volume. Only a couple points of that are price. Now, price is up a little bit more if you look year to date at the more luxury end of the travel spectrum, but it's not up tremendously. The pricing increases that we saw in 21 and 22 were unique. It was a unique period of time. Those have come off quite a bit in 23 and 24, but the prices have stayed high. So I think what you're reacting to is that high level price more so than a dramatic increase in price that's happening right now. We're not seeing that today.
So what's the number one destination right now?
Look, for Americans, one of the most attractive destinations is Mexico and the Caribbean. Always has been and always will be. Lisa mentioned Italy. We actually see Italy being off a little bit right now from Americans. I don't think that's because of the tariffs. We saw that before. I think that's coming off of the incredible peak last summer in Italian travel.
So right now, going forward, what are going to be the signs to you that there is a material shift? Where do you expect to see it first? In the low end, the medium term, the high end, the bleisure, which we talked extensively about? Where do you think what will be the sort of front-leading indicator?
That indicator we have already seen a bit, which is, I would say, the lower end, bookings to select service hotels, to mid-scale economy hotels, those are not as robust as they are at the luxury end. Bleisure is definitely not bleisure. Bleisure, we've talked about this term before, it's a terrible word, but 75% of people want to combine business and pleasure trips, bleisure, right? But we are seeing, we have seen pretty soft trends at the more economy level. So I think that's where you're seeing it in the data, and that was before last week.
Eric, it's good to see you. Keep us updated.
Great to see you.
Thanks for dropping by. Thank you. Eric Resnick there of KSL Capital Partners. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. China is reducing the number of imported U.S. films and introducing more films from other countries. According to a statement from the Chinese government, U.S. tariffs on China will make the films less favorable to domestic audiences. Elsewhere, Lego has opened a new factory in Vietnam. The world's largest toy maker says it plans to invest $1 billion over 15 years in the complex, which will produce toys for Asia. Lego's CEO told Bloomberg that the company sees growth in new markets as a buffer against any possible headwinds from tariffs. And a new United States Postal Service proposal would see first-class stamp prices increase by 5 cents starting in July. That amount ties the record as the highest increase ever. It'll be the first of 5 planned price hikes for stamps currently planned through 2027. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on in the program. Up next, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
I don't think there's any case for the Fed to cut interest rates.
The Fed can't play the hero anymore.
Up next on the program, the former Kansas City Fed President Thomas Hoenig joins us next. Live from New York, this is Bloomberg. Equity futures negative here by 1.6% on the S&P. On the Nasdaq 100, we are down by 1.9. On the Russell, by 2.4. Out of Savannah's this morning, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
Now what we're seeing is deglobalization. That ties the Fed's hands. And the Fed can't play the hero anymore.
I don't think there's any case for the Fed to cut interest rates.
It would be best for the Fed to be patient as we go through this price shock.
They're kind of in a position where they can't act. They're going to have to wait and see.
So here's the latest this morning. The Fed isn't blinking in the face of downside risk to growth and upside risk to inflation. The former Kansas City Fed President, Thomas Hoenig, looking ahead to the March CPI print due in less than 1 hour, writing, there will be an expectation that if it is favourable and if oil prices continue lower, the Fed should be thinking about an interest rate cut. Thomas joins us now for more. Thomas, welcome to the programme, sir. Let's just take a step back. I'd love your opinion, your view on how you think the Fed has conducted itself over the last week. Have they done all the right things?
Well, yes, I think they've done all the right things. They've stayed calm, apparently. At least on the surface, it seems calm, although I think they're very much aware, we're very much aware of the effects of the tariffs, and around that, the risks it had for liquidity in the various markets, especially the Treasury market, as you saw the yields going up fairly rapidly without anyone having a clear explanation of that. And they've kept calm. So yes, I think they've done pretty well this last week. I think their challenges still remain. The tariffs haven't really, the war has narrowed, but we're still in a tariff war, especially with China. And so there's a lot of uncertainty remaining.
Thomas, I'm curious what you think the Fed could have done or should have done should that dysfunction have continued yesterday. And I ask you because there was some speculation that it would have prompted them to have some sort of emergency quantitative easing. Do you think that that type of bond purchasing is a tool that they are really looking at right now in the face of perhaps potentially additional turmoil?
Well, I don't think they're looking at. I don't think they're looking there yet. I think they were watching it very carefully. And I have to tell you, one of the things that you need to think about here is, as we have dealt with this tariff and the uncertainties that it brings, it also brings to the front, I think, a bigger issue. And that is the national debt is going to go up. I mean, we have this resolution, we'll have another $2 trillion of deficit, the debt grows. Who's going to fund that? And if the world's saying, well, wait a minute, I can't rely on the U.S., that becomes more problematic for the U.S. and for the Fed, because if your foreign buyers of our debt recede somewhat, even modestly on the margin sometimes, it puts more pressure on the domestic market to do that, and that's putting pressure on the banks. That will then put pressure on the Fed. And it's when that begins to occur, if we continue with the trade war, that I think the real pressures on the Fed will come forward to monetize, that is, buy some of this debt. One other thing I want to point out to you, though, is you may have seen where there is a proposal, and the Secretary of the Treasury talked about it, the incoming Vice Chair for the Fed on supervision talked about it, and that is removing exempting treasuries from the so-called capital leverage ratio. This is very significant because it means the banks don't have to capitalize any of this national debt. Their cost of capital will be favorably affected. And that's designed to make them more able to buy more of the U.S. debt. That is, a banking industry to buy more of the debt. And then when they put that debt on, the Fed has to backstop that for liquidity reasons. If the interest rates were to shoot up, the Fed would have to be right there. So the Fed's it's going to still be the backstop, but in a little bit different way.
How much is this the reason why you're hearing from an increasing number of Fed officials a real priority on inflation ahead of even the employment mandate? And Minneapolis Fed President Neil Kashkari wrote a blog post this morning where he came out and said, our first priority must be keeping long-run inflation expectations anchored. And he said, in my view, the hurdle to change the federal funds rate one way or the other has increased due to the tariffs. Do you think that this prioritization of inflation over the employment mandate, over the dual mandate, is what they have to do?
I think it is what they have to do, frankly, because, we've said it for years in the past. That is, you can't have maximum employment without stable prices. And inflation right now is 3%. That's 50% above their target. And 2% inflation is a fair amount of inflation over time. So I think it's about time the Fed refocused. In the 2010 period, they decided to make the dual mandate in the sense of employment much higher, that part of the mandate much higher. And Chairman Powell has emphasized that even more recently. And that, I think, takes shall we say, the eye off the ball. They have to focus on inflation. It's not going to come down a lot today, I suspect, when they report it. That's even before the tariff war. So, yes, I think Kashkari is saying the right thing.
How difficult is it to focus on inflation when the goalposts keep moving in terms of the rates the U.S. is going to charge trading partners?
Well, that's the difficult thing, because the U.S., instead of focusing on its national debt and its increase of national debt and the debt that has to be funded, they're starting to fight a war, a trade war, and therefore they've taken their eye off the ball in one sense, made it more difficult for the Fed and for the Treasury for that matter. So they need to get back to, we can solve a big part of our trade problems if we solve our own national debt problem and our spending, our government spending problem, which is a problem. And they're not looking at it, I think, carefully enough.
Yesterday, we had the U.S. Chief Justice letting the President of the United States, Donald Trump, remove 2 agency leaders for now. Are you concerned about Powell and his position?
Well, I think this is a big deal. I think the fact that you can fire board members of an independent agency, the Fed is always thought to be special. I saw where one of the justices said that. But when you come down to law, if they make that decision for one independent agency, people have got to immediately think of what does that mean for the others, and that includes the Fed with its independent board of governors.
What kind of market response, Thomas, do you expect should there be some sort of threat to Jerome Powell and his role as Fed chair?
I think it will be pretty significant because it clearly says we're going to politicize the Fed completely. And what's going to happen then? That's another source of great uncertainty in the market. And I think it will be destabilizing to a degree.
How much do you care about CPI, which comes out in about almost 40 minutes?
Well, I care a lot about it because it tells people where are we taking things. And, 3%'s been there for a long time now, more than a year, in my opinion. And it's not coming down. They're going to spend a lot more money. The Fed's going to be under a lot of pressure to monetize some of that. The banking industry is going to be under pressure, especially if they make it easier for them to take on these debt. So there's no discipline to our fiscal side. And the Congress is going to pass another very significant spending and, shall we say, borrowing bill. So, yeah, CPI is going to tell the world where we're headed.
CPI drops at 8:30 Eastern Time. Thomas, appreciate your time. Thoughtful stuff. The former Kansas City Fed president, Thomas Hoenig, there, going into the next Federal Reserve meeting. The first week of May, Bramo, not too long away.
Honestly, what are they going to say, given the fact that right now they've played it cool? They've said we don't want to get ahead of our skis, but they have to talk more about what tariffs do. And we are hearing some of that from Neil Kashkari saying that the bar is a lot higher for them to move either way, which is the first time I've heard rhetoric like that for a while.
If we don't have the trade deals and the goalposts keep shifting, we don't know what the final rates are going to be, how does the Fed take anything into consideration and decide to cut? Because they don't know what the future is going to be. Imagine they moved before Trump's decision yesterday to pull back.
Then they're offside.
Exactly. It's very difficult right now. And the uncertainty is not just pervasive in the business community, in the media, trying to understand what the Trump administration is doing, but it is at the Federal Reserve.
The fate of the economy at the moment dictated by one individual who can dictate how talks go over the next 90 days or so. Equity futures at the moment on the S&P 500 negative by 1.6%. In the bond market, we get a bit of stability after a rocky few days. In the bond market at the moment, yields are lower by 3 basis points, the 10-year 4.30. On twos, we're down about 5 or 6 basis points at the moment, the yield 3.85. The data drops 8:30 Eastern Time. In the next hour of Bloomberg Surveillance, we'll catch up with Greg Boutle of BNP Paribas, Erika Najarian of UBS, Torsten Slok of Apollo, and David Kelly of JPMorgan Asset Management. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance just around the corner.
I don't think Fed cuts are necessarily the help the investors might be hoping for.
I don't think there's any case for the Fed to cut interest rates.
It's going to be best for the Fed to be patient as we go through this price shock.
What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher.
Now what we're seeing is deglobalization, which is now an inflationary process that ties the Fed's hands. And the Fed can't play the hero anymore.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning to you. Equity futures on the S&P 500 negative here by 1.6%. Let's check out the price action and move to the Nasdaq. We're down by 2%. This was the biggest one-day pop since 2008 on the S&P 500. Coming off the back of it with some declines. What's changed? Not much has changed. We still face 125% tariffs on China and 10% tariffs across the board. If you're looking for what's happening right now in the bond market, bond yields at the moment down by a few basis points. We're down 3 on 10s to about 430. On 2s, we're down 5 or 6 basis points to 385. And Annmarie, the bond market playing a major part in the back down from the president in just the past day.
It is absolutely. When you heard from Scott Bessent, the Treasury Secretary, and the president, that they've been thinking about this for a few days. The Treasury Secretary talked about the fact that he was at Mar-a-Lago on Sunday. They had this meeting. He came back with the president to Washington, D.C. But then it felt like yesterday morning, and the president talking about the bond market overnight. He said it's tricky, but now it's beautiful. And he looked at it. And apparently that was the final threshold for this president to decide, I need to walk some of this back. We're going to go all in and dig our heels in when it comes to China. But our other trading partners, we're opening the doors. You have 90 days to strike a deal.
Does it put a ceiling on the volatility? Later on this morning, it's going to be about the economic data, 8:30 Eastern time. We get US CPI. That's the next stop for this debate in this market. Inflation data, Lisa, just around the corner.
And how much does it actually matter given the volatility that we're getting in some of the policy? We just heard there from Thomas Hoenig, formerly of the Federal Reserve, saying it does matter quite a bit to get a sense of where we're coming from. And I think that will matter, but also what will matter is data like how much foreign buying will there be? How much are people actually buying the bond market when there is volatility in the stock market? And those are some of the data points that might be more constructive going forward about the future path.
Truly historic swings worldwide in the past few days. Coming up this hour, we'll catch up with Greg Boutle of BNP Paribas as stocks whipsaw on changing tariff policy. Erika Najarian of UBS looking ahead to bank earnings, and Torsten Slok of Apollo reacting to the latest read on inflation. We begin this hour with stocks struggling to add to Wednesday's major rally. Greg Boutle of BNP Paribas writing, bear market rallies can be very large and violent. A short-term market rally and compression vol, similar to what we saw yesterday, sets up entry points to add hedges ahead of earnings season. Greg joins us now for more. Greg, good to see you.
Good to see you.
Would you describe the last 24 hours as just a bear market rally?
I mean, it has the attributes of it. If you go back through history and you look at what were the largest one-day rallies for equity markets, they all occurred in bear markets and generally not at the end of them.
The president's in control here. He seems to dictate things. Does that make it different?
I'm glad somebody's in control. I think it makes it incredibly hard to navigate. We see that the way things have flip-flopped over the last week. I think anyone who says they have certainty on where the growth outlook is going, where earnings are going, where the tariff picture is going to settle, is probably exaggerating somewhat.
How much do we have a real price check at a time when anyone who tries to short this market is, you know, we talked about this before, going to get their face ripped off based on a tweet? How can you really get any conviction to give a check on any potential volatility?
I think one of the things that we've seen develop over the last couple of years are flows in the equity market that have changed the market structure of how the equity market trades. We saw absolutely massive flows yesterday. Some of that was discretionary buying. There were very large inflows into the ETF complex, but some of it is systematic. There's essentially a short gamma profile in the market, which means there are forced flows when the market has large moves. So we think these systematic flows contributed more than 50 billion of buying flows yesterday. So this is something that amplifies moves in the market, both on the downside and the upside.
This is important. CTAs you're talking about, right? To some degree?
I'm not talking about CTAs. So CTAs are trend following that contributed to the first legs of this sell-off. But what we're talking about is more flows from things like the levered ETF complex or rehedging of option flows.
Okay, so if that's the case, how much does that structurally mean that the biggest tech stocks will keep trading like penny stocks for the foreseeable future? Because if that's the dynamic in markets, that's how you get a $1.7 trillion increase in valuation of just 6 names.
It creates this reflexivity that when you have large moves, say a 5% move, it's much easier for it to snowball into a 10% move, as we saw yesterday, than it would be in another market regime. So that's something that's structural, and it hits there.
So you think the next leg lower is down? Sorry, the next leg is lower.
I think it's more likely that we revisit the lows than we don't. I think looking forwards, things are going to move a little bit from a very macro headline-driven environment to one where we try and distill what is the impact for this. Earnings season is coming up. Obviously, the backward-looking earnings aren't going to be a focus, but the forward-looking guidance and the commentary from CEOs will be.
So what do you do in the next 90 days if everything is headline-driven and they're working on striking deals with 70 trading partners?
I think you have to look for asymmetric opportunities. So the option market is really where we would focus. And it has been challenging because equity volatility has absolutely exploded. But as we get moves like yesterday, when the market rallies, we see volatility come in rapidly. And we think that can give some opportunities to strike hedges. So one of the things you can look at is the implied probability from the options market as to where the market could trade. So, for example, if you think the Nasdaq is going back to where it was just yesterday morning by the end of next week, the market implied probability of that is about 10 to 1.
So you have a Trump put and a Trump call. Basically, what are they? What's the price? What's the strike price?
So I think the strike price is less of a market level, and I think it's more a function of volatility when things are breaking. This is also how we've tended to think about the Fed put historically. People will ask you, where is the Fed put struck, thinking that you can think in S&P terms. My view is it's more when things start to become dysfunctional and you get signs of stress in the market, that's when you're more likely to see a policy put kick in.
We're talking about the most liquid, deepest, most traded market in the world. And we're talking about a greater likelihood of a 10% move on any given day, up or down. John was saying earlier that if we were talking about Chinese stocks, we would say almost uninvestable. How much does that change the profile of U.S. markets in a pretty profound way if this is the new normal?
I think it obviously has an impact on people's ability or willingness to put money to work. The anecdotal evidence, though, is that there are still pockets of the market, I think particularly retail, who have this very entrenched buy on dip mentality. And right now the flows tell you that is still what they've done right the way through this crisis.
Oh, you don't think we shredded that at all over the past week or so?
No, I think the anecdotal evidence of that in terms of what we see in flows is that there was dip buying from retail last Thursday, last Friday, and indeed at the start of this week.
Domestic retail. What about international, institutional?
I think it's much more challenging for institutional investors, particularly international investors. And I think when we look at the positioning data that we track, we basically saw that the institutional positioning landscape basically reached capitulation point going into yesterday. And that also, I think, plays a part in the velocity of the move higher.
So at this point, going forward, how much do you see a reduced interest in U.S. equities than you had from international investors? Or is this just a momentary blip? Do you get the sense that maybe this isn't necessarily structural? This is a moment in time that we're going to look back on as, oh, yeah, that time, but we've moved on?
It was something where this was already emerging at the start of the year in a more positive than negative way, where people were starting to look at other markets such as Europe and make a more positive case, which definitionally means some rotation out of other markets that are overowned, like the US. So I think at the back of people's mind, there is this idea of this rotation trade can play out. But when you go to markets like Europe, which have historically been more volatile, had fatter tails, tend to have more leverage and lower quality corporates in general, that's a hard thing to navigate in this market.
Is this fun?
It is a little bit, yeah.
Is it really?
I think it's something that if you work in markets, then when you get some of the largest moves in markets, you get massive outliers understanding why and what's driving that.
Tweet or truth posting.
Off one tweet, yeah.
Yeah, so that's fun, evidently.
You're going to be saying that in a few weeks' time?
Probably not.
Yeah, I wonder. Greg, it's good to see you.
Thank you.
Appreciate your time. Thank you, buddy. Greg Boutle of BNP Paribas. Truly historic moves we've seen in the past 24 hours. And one social media post shaking up this market big time, sending equities to a monster rally and attempting to put a floor in this bond market, because the moves we saw in bond yields over the past few days clearly unnerved the White House. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of those moves from the White House, President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. The move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. The U.S. and Vietnam, though, are set to start negotiations on a trade deal. The two sides have agreed to consider minimizing non-tariff barriers and strengthen coordination to prevent trade fraud. Vietnam was among the first countries singled out by Trump for showing willingness to negotiate. China has bought an unusually large amount of Brazilian soy this week. People familiar with the matter telling Bloomberg that importers scooped up at least 40 cargoes of beans, taking advantage of the recent dip in Brazilian prices. It also comes as U.S.-China trade tensions escalate. Soy is America's top agricultural export to China. And that's your brief, John.
Brazilian farmers driving around in Lamborghinis at the moment, that's for sure. Up next on the programme, the morning calls. Plus, a little bit later, we'll catch up with Erika Najarian of UBS. Looking ahead to big bank earnings. That kicks off tomorrow morning. Live from New York, you're watching Bloomberg TV. We said this yesterday morning, you can't look away from the Bloomberg terminal at the moment. Blink and you miss it. It's a 10% rally. just like that. Equity futures on the S&P 500 at the moment negative by close to 2% on the S&P. On the Nasdaq, we're down by 2.4. Just a little bit of stability for now in the bond market. Let's see if it sticks. 10s at 432. At the moment, 2s at 388. Let's get you some morning calls. First up, Goldman Sachs downgrading Ford to neutral, citing weak demand and higher costs from tariffs. Your second call from Mizuho, lowering its price target on Tesla to $375, noting Trump's 90-day tariff pause does not apply to autos. Tesla's down by 3.75%. And finally, Dan Ives of Wedbush cutting his price target on Microsoft to $475, pointing to uncertainty from the, quote, tariff game of poker. That name is down by 1.5% in the pre-market. Let's turn to the big banks. Earnings kicking off with JPMorgan, Wells Fargo and Morgan Stanley reporting first quarter results tomorrow morning. Erika Najarian of UBS writing management teams are between a rock and a hard place, as any outlook seen as quite bearish could also punish the sector. Erika joins us now for more. Erika, always good to see you.
Good to see you.
What do they tell us tomorrow morning? What can they tell us?
What can they tell us that will matter? A lot of investors are thinking that whatever they'll say, which is actually not so bad, is going to be seen as backward looking. Now, I think there are really two things that investors are looking for. Number one, are activity levels now just permanently impaired from both the corporate side and the consumer side? So clearly we had this animal spirits economy that we really wanted to come through. And if you're a corporation, how do you make decisions in this environment, right? And so as you think about investment banking and loan growth in commercial, you would think that has to be at least delayed. Although I wonder if the equity market continues to rally, obviously not today, but I wonder if there's some deals that it's going to get pushed through the pipeline over the short term. On the consumer, American Express is not normally seen as a bellwether report, but given that 10% of Americans account for, or high-end Americans that make $250 account for 50% of the spend, all of a sudden they're a bellwether report, because if they're slowing down, that's not good for consumer activity for the rest of the year.
So the banks are the best data points we have at the moment. It's the best real-time data we'll get. A lot of people looked at payrolls and just said that's old news. When you were in touch with the management teams over the past few days, you put together a picture of where things are at currently. What are they telling you about activity at the moment? Have things slowed down?
Things are slow. If you look at the regulatory data and you catch up with the banks, commercial activity, it's slow. It's quite flat. And if you look at the deal logic data, I mean, it's depressing. The whole capital markets renaissance is just not quite happening. But trading, as you can imagine, given all this volatility, trading could be lights out for this quarter.
Okay, hold on a second. I remember when we used to get volatility, and it was good volatility, and then it was bad volatility. Yes. And volatility isn't always a good thing. So is this good volatility or bad volatility in terms of bank profits?
So far, again, speaking about backward looking, if you think about the month of March and think about the equity market volatility, sell-side desks are typically long volatility, so that could be good for them. Now, what makes me nervous is what's been happening to the Treasury market in terms of dealer capacity. So the key question for the month of April is, is there something going to happen? Is there bad volatility now happening in the fixed income markets that is not going to be good news for the second quarter?
So going forward, what do you think is going to potentially be the bigger driver? Is it going to be the trading side of things, or is it going to be the M&A wave that doesn't come to pass? Or is it going to be deregulation, which we've seen some of, but not necessarily the full package?
So investors just never really value trading earnings much, right? It's super volatile. It's like throwing a dart on the board. Who knows in any given quarter, right? I think what they're really looking for is, honestly, any signs of credit at this point, because the reaction of banks up until yesterday really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, let's say if credit costs go up in anticipation of a tougher economy, I think that's what the market sort of needs to hear for now. On the deregulatory point, what's gotten lost in all of this is I feel like the deregulatory momentum in Trump 2.0 is actually much stronger than Trump 1.0. I mean, we went to that lunch. I mean, he started off, Secretary Bessent started off with bank deregulation at this lunch at the Economic Club in New York, and everybody just wanted to talk about tariffs. And he started off with bank dereg. But for now, until we understand, the range of outcomes for the economy, the macro volatility uncertainty will trump the deregulatory positive catalyst.
But do you even believe these CEOs when they come out and potentially say we're not going to have a recession, or we are? Goldman Sachs pulled their call yesterday after Trump came out and blinked.
Again, rock in a hard place, right? So, if you think about how banks set credit costs, they think about the future, they think about the outlook, and they're saying to themselves, well, I don't know what the outlook is, so perhaps they're going to build reserves a little bit, but you don't have an inventory of losses that are coming down the pipeline. Card delinquencies are actually flat to down, and commercial delinquent or non-performing loans are pretty flat and improving. And so it's tough, but they have to talk defensively, or else investors will think they're burying their head in the sand.
It's an important point you brought up about Scott Bessent at the Economic Club of New York, where we saw each other last, because he wanted to talk about deregulation and tax cuts, but the entire room wants to talk about tariffs, because at the moment there was all this uncertainty what they were going to do with trade. When you take the entire policies of the Trump administration, deregulation, tax cuts, and tariffs, how much more constructive is that for banks towards year end?
So deregulation is super, super constructive, right? Particularly as we start thinking about changes in the stress test, which I think could be a 2026 catalyst. I know it's not 5 minutes from now, as we like. So deregulation, I think, is a big catalyst. Tax cuts, obviously the continuation of, the Tax Cuts and Jobs Act would be, beneficial for corporate activity, but that's something that's already embedded, right? It's already baked in the base case. So just extending that isn't necessarily going to pump up activity, which goes back to trade, right? It's like the big overhang that is overshadowing everything else that's good.
So do the big banks benefit the most from deregulation and an uncertain regime where they consolidate a lot of trading volumes?
So I think that in a deregulatory environment, you get to unlock a lot of excess capital. And I think that's great. But if there's not a lot of demand for that capital other than trading, what good is it to unlock excess capital, right? And by the way, remember, buybacks tend to be very pro-cyclical. Like, if we're staring down the barrel of what we stared at last week, I don't feel like bank management teams are going to be like, I'm going to buy back a ton of stock now, right? They tend to be like, well, we're going to keep the capital, tight and excessive for a rainy day. So, we have this regulatory or deregulatory momentum to unlock the excess capital, but we need somewhere to put it. And I'm not sure it's going to be like shoe factories in Binghamton, right?
Do you think there's some pressure on them to cut costs now?
Pressure to cut costs. I think it's too early. I mean, trading is great. No one is giving up on the outlook yet for investment banking. And, especially a lot of regional banks have PTSD from cutting too much in 2023. And now, they're, lost some A players, and now they're scrambling to hire even like a B+ player, right? So I'm saying, so there might be some durability in costs. It's too late to use that as a lever.
So
too early, rather.
Looking across the companies that you cover at the moment, just identify a couple that you do like in a moment like this one, because this sounds tremendously bearish at the moment, but I'm sure there's some names you like.
So,
what do you like at the moment?
Counter to everything that I said, I am obsessed with Capital One. I think that, here's the tagline: cycles are temporary, but networks are forever. And buried under all of the Liberation Day chaos on Thursday was the New York Times headline that the DOJ is okay with the deal, right? And this is a once-in-a-lifetime deal for Capital One to own a debit network and a credit network. So in an environment like this, I have no idea what the macro is, or else I wouldn't be sitting here. I'd be on the beach, right? But in that case, what investors will support and like are stories where they can self-start, they can, grow earnings power in a different way that's completely exclusive of the macro. And that's what's happening with this Discover deal.
We all want to come to the beach with you. Erika, it's good to see you. Thanks for dropping by. Thanks for your time. Erika Najarian there of UBS, looking ahead to those bank earnings that drop tomorrow morning, kicking off things on Wall Street with JPMorgan. In just a moment, 8 minutes away, you'll get US CPI, the latest read on inflation data in America. Mike McKee joins us now for a preview. Good morning, Mike.
Good morning, John. Well, coming into this, everybody's kind of expecting a little bit of good news, a drop in the year-over-year rate of inflation for both the headline and the core. The core is going to get a lot of attention because people are going to want to see what happened in terms of prices during the month of March. We did have some tariffs on. So did they affect particularly goods coming in from China, apparel, furniture, toys? And we'll keep an eye on that for you. And then jobless claims have just been a good news story ongoing, even though we've seen all these reports of layoffs from the federal government. And now we're beginning to see them from companies. So what is the status of the labor market? That's another one to watch because Fed officials are saying labor market's okay. They're on inflation watch. Let's see if the data give them anything to watch today.
Mike, Fed officials did not blink. And a lot of people frame the situation they're in at the moment as facing upside risk to inflation and downside risk to growth. And they seem to be very keen over the past few days to really lean into the idea that they are going to anchor inflation expectations. That seemed to be the priority of Chairman Powell going into the weekend. When do you expect this inflation data to change, Mike, in the months to come off the back of some of the announcements we've seen from the White House over the past few weeks?
Well, we could start to see it this month in the April data if we see prices go up for goods coming in from China, because remember, he raised tariffs on China in February, so we could see an impact there. But it would probably take another couple months before the rest of the world gets to that point, because you don't know what people have in inventory and you don't know what is on its way and when it would hit the ports. But probably by the June meeting, the Fed would have an idea of where they're going.
And there's a meeting between now and then. Mike McKee, appreciate it. May 7th is going to be an interesting one, Lisa, for this Federal Reserve. A Fed official you follow closely, the San Francisco Fed President Mary Daly, making the point that she believes the policy is in a good place.
Yeah, because they cut by 100 basis points. It still is, less restrictive, but at the same time, it's restrictive enough to bring inflation down. There is dissonance for them because on one hand, they're looking at companies that still have pretty healthy situations with consumers that are still spending, but they have to project forward at a time where that's unknowable. Erika Najarian was saying that, if, next year isn't 5 minutes from now, which might not be desired. Actually, I think it would be very desired for a lot of us. And it's sort of hard to see the path from here to there.
And we're in the midst of a trade war now between Beijing and Washington. Look at the headlines this morning. You have China coming out and saying, actually, we're going to ditch some of our U.S. soybeans and we're going to lean into Brazil. It's exactly what they did in 1.0. And guess what the U.S. government had to do? Trump's administration in that time around, they had to go to Congress and ask for a bailout for our farmers. So if you're the Federal Reserve, how difficult are these decisions in the midst of really whipsawing policy and the escalation from trading partners?
Got some deals if you want to talk about it. Prada agrees to buy Versace. Enterprise value of $1.375 billion. Got a deal there. You happy with that one?
That's why I wore Prada today. I was expecting this deal to come through for Versace. No, I'm just kidding. I did not know that. Well, luxury, I guess, back in play. Remember, it was that former deal between the FTC wouldn't agree upon when it was the handbags, Jonathan?
Yes, entry-level luxury.
Yes. So this is full luxury. And I guess Prada's expanding.
This is super high-end luxury. Inflation data up next. Let's move on from that conversation. Torsten Slok of Apollo joins us in just a moment. David Kelly of JPMorgan Asset Management here to react. From New York, CPI up next. Inflation data in America just seconds away. CPI just around a corner. Your scores going into it look like this. Equity futures on the S&P down by 1.9% on the S&P 500. Yesterday, the biggest one-day pop since 2008. This morning, declines resume on the Nasdaq, down by 2.3. In the bond market, bond yields, 2-year, 10-year, 30-year. Your bond market looks a little something like this. The 10-year Treasury at the moment, yields down by 4 basis points. Your yield, 4.29. Your data with Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in much better than expected on headline CPI and a little bit better than expected on the core, up by 0.1%. The forecast was for 0.3. and that pushes us down to a 2.8% annual rate for core, which is going to be the lowest in some time. I'll have to get a statistic on that for you. Headline goes down by 0.1%, and that pushes the number to 2.4% on a year-over-year basis. We're getting very close to the area in which the Fed thinks we should be, what they're looking for. Jobless claims right on the screws. Forecast 223,000. We get 223,000. Continuing claims 1,850,000, and that is a bit of a decline from 1,893,000 revision to last week. So are we getting any kind of pop from this, John? I'll check the details here while you...
We're seeing some moves, Mike, but in the bond market. So yields down at the front end of the curve. We're down 9 or 10 basis points. Your 2-year at the moment back to 381. But the volatility we've seen at the front end of the curve has just been unreal. As we mentioned a few times on this programme yesterday, a 38 basis point trading range intraday at the front end of the curve. This morning on 10s, we're down about 4. So off the back of that, you unlock some dollar weakness, euro strength. Euro dollar now highs at a session through 111, 111.22 at the moment on that currency pair. Equity is the smallest of bounces. At the moment, we're down about 1.4%. Mike, as you go through the details, when you get softer prints like this, just to frame things, typically we'd have a conversation about the Federal Reserve maybe getting some confidence to reduce interest rates even more. But Mike, this time around, I just get the feeling that for the Federal Reserve, they've just got to wait a whole lot longer to see how these policy changes of the past few weeks bleed into the data in the coming weeks and months.
Absolutely. This is backward looking, and it's also been eclipsed by the tariff news, which should push up inflation. So the Fed is going to look through this. It's good news. It shows that they were on track. Remember, they were telling us that we were going to get down to 2%. They'd leave rates where they were, and that would put pressure on inflation. So to the point of Trump putting on tariffs, they were making progress. Now the question is, what happens from there? And speaking of Donald Trump, here's something that's not necessarily going to be good news for the White House in these inflation reports. It was energy. Gasoline prices went down during March, and that held the headline number down to a 1/10 decline. But food prices went up by 0.5%. Food at home by 0.5%. So people are going to go to the grocery store and say, well, we're not seeing inflation relief here, and the president promised that. That's something they're going to have to deal with.
Mike McKee on the latest data. Mike, we'll come back to you in just a moment. Stay close. Torsten Slok of Apollo joins us around the table. Torsten, good morning, sir. It's good to see you.
Morning.
Can I ignore all that?
Well, this is a Goldilocks starting point for the Fed, at least. I mean, the dual mandate says inflation should be 2. We moved a little bit more in that direction, better than expected. And on jobless claims, we also had a labor market that still is reasonably strong. So from that perspective, this is absolutely good news for the Fed that we did not get yet any inflation surprise to the upside. But obviously, we still have tariffs in the pipeline. And what's left on the tariff front could still add as much as 1 percentage point to tariffs over the next, to inflation over the next 12 months. So in that sense, this is backward looking, as Mike is saying. The risks are, of course, that there's now more upside coming to inflation.
So this is the issue, and it's a sequencing issue, and I'd love to get your thoughts on it. So sentiment's collapsed, basically created over the past few months. What we've started to see with CPI is just a bit of softness. That's encouraging. How long before we see the weakness in the output data, before we then see the higher prices in months to come? What comes before the other?
Well, let's think about how companies might respond to this. So now you know tariffs are coming. For example, if you think about Amazon, of the sellers on Amazon, 71% they source their goods in China. So one very important aspect is that it will be visible for everyone that prices are going up on things that are imported, of course, from China. So the conclusion to your question is, how do you respond to that? Do you take your existing inventory and sell that at the old prices? Do you take your existing inventory and raise the price immediately? That profile will probably be individual for different companies, depending on the competitive situation, which sector they're in, how sensitive they are to tariffs. So we just don't know yet what the impact will be and how quickly this will feed through. But we do know that higher prices are coming as a result of goods coming from China becoming significantly more expensive. So even if companies decide to sell the existing inventory at the old price, we will over time see some upward pressure on goods inflation coming from this source.
Is there a risk that we ignore this data at our own peril? The idea that actually lower energy prices are giving more disposable income to consumers to potentially go out there and buy, and that, oh yeah, it's also an offset for a lot of potential producers in the U.S.?
Absolutely. Low energy prices is very, very helpful for the consumer. But the other thing, of course, is that the whole surrounding sentiment around what's been going on is that we literally went from the last few days, from nuclear winter to now back to talking about stagflation. And stagflation has these risks, of course, that you have headwinds from consumer sentiment being weak, corporate sentiment being weak. If you look at the Fed surveys for capex planning, they are really beginning to turn south. So companies are beginning to pull back more, likely because of the uncertainty. And let's not forget, we still have a $5 trillion net wealth effect on consumers from the stock market going down. So if I add this whole list together of weaker corporate sentiment, weaker consumer sentiment, tariffs coming, and a negative wealth effect, and on top of that also retaliation from foreigners who might be doing things to us simply because of the trade war. That brings you a fairly long list of downside risks to the outlook overall.
Which raises this issue of how we even game out the idea of inflation. Why potentially are we not talking about deflation or disinflation? And I say this given the fact that we see Walmart, for example, saying that they are going to invest in price competitiveness. Basically, they're going to absorb all of the costs from tariffs. At what point could potentially the lack of demand be the main story more than inflation?
And that's why the key issue here is who is going to absorb the increase in tariffs? Who's going to absorb the price increase in goods that are coming here, in particular from China? Is it going to be consumers that will face higher prices? Or is it going to be taken out of margins? Will the E in the PE ratio go down as a result of this, as companies such as Walmart, Costco, and of course Amazon begin to say, well, maybe we are going to absorb some of this. And that remains to be seen exactly. Maybe it's going to be split across corporates and across consumers. But the bottom line still is that someone has to foot the bill when tariffs are going up.
Wall Street Journal has this morning that the president privately acknowledged that his trade policies could potentially lead to or trigger a recession, but he said he wanted to make sure it didn't cause a depression. Where are you now in terms of potentially having a recession this year?
So, of course, the last few days, it was pretty clear that there would be a sudden stop in the economy where prices would go up significantly, literally on all trading partners and everything coming in. So that was a scenario where a recession was very likely, almost at 100% where we came from. Today, the recession probability is probably 50-50%, meaning we think that there is still a likelihood we will have a slowdown. But the risk is we just don't know what the response is going to be from consumers, corporates, how much will markets go down further. In particular, this wealth effect on its own. Think about how we normally talk about when the stock market is going down. We go back to the spreadsheets and say, what's the marginal propensity to consume? How do consumers react when the stock market goes down? Here on its own, the stock market down now 5 trillion so far. And of course, now it's rebounding and then coming a little bit back again. That's on its own a fairly significant hit to consumers and the wealth effect for the consumer outlook.
We still don't know what the policy will be in a few months' time, including the tax code. This came from the president just moments ago. A social media post saying, great news, the big beautiful bill is coming along really well. Republicans are working together nicely. The biggest tax cuts in US history getting close.
Well, it's because yesterday they had to pull a vote to vote on the budget resolution from the Senate in the House because fiscal hawks are saying that Senate bill doesn't do enough for cuts. So what's happening this morning? Speaker Johnson, Leader Thune are having a press conference later this hour to outline a plan to get Trump's tax cuts through. The president sees this and he says, oh, look, they're working together now. This morning, they weren't working together last night.
Can they change the conversation? Moments ago, we just had CPI data. Let's bring Mike McKee back in for an update. Mike, you've had a second look. What stands out?
Well, a couple of things, John. We talked about grocery prices, and meat prices were up 1.1%. Chicken prices were up. Pork prices were up. So people will really be noticing it at the meat counters in their stores. More bad news for the president. He'd been bragging about the price of eggs coming down, but they rise by 5.9% on the month, which puts them up 60.4% for the year. Last month, it was 58%. So egg prices are going back up. Now, the China impact, perhaps. We saw furniture prices rise on the month, and that is something we get a lot of from China, up 0.6. Bedroom furniture up 2.7%. Apparel up 0.4 after a 0.6 rise the month before. Also something we do get a lot of from China. Toy prices went down, though. Maybe that's because Christmas and Hanukkah are behind us. Smartphone prices, surprisingly, go down by 1.1%. So maybe that's an inflation number that is coming, but is not there yet. The big, well, let me do housing because everybody follows that. Owner's equivalent rent up 0.4. That's a rise of 0.1%. So I was going to say the big thing that people are going to be watching going forward is energy prices, which were down 6.3% for gasoline. If that continues, it takes some of the edge off the food prices, and it does help the administration's case a little bit. But all in all, this is sort of a mixed report. The things that we thought would go down, airfares were down 5.4%, did go down. Some of the things we got from China did go up, and that's something that could continue with the big tariffs that they now have.
Mike, thank you for the update. Mike McKee there, following inflation data about 10 minutes ago. David Kelly of JPMorgan Asset Management joined us now for more. David, welcome to the programme. How encouraging is that data this morning?
I don't really think it changes the narrative much. I think, Mike McKee was pointing out that airfares are down 5.4%. Actually, lodging, hotels and motels and so forth, was down 4.3%. So I think what we're seeing is a lot of softness in the travel industry, which I think is going to get worse over the course of this year. It is the calm before the inflation storm. We're going to get some higher inflation out of the tariffs. I mean, remember, we left the 10% universal tariff in place. That's a lot higher than anything we've seen really for decades. So that's high. And then, of course, there's enormous tariff on China, which is going to clog supply chains and push up prices too. So I think we will get some inflation there. But what I actually see in the data, looking particularly at the travel numbers, is a sort of a deflationary tinge to the economy or slowdown tinge to the economy already. So, I'm glad that the market rallied yesterday, and I'm glad that we've got rid of the worst of the reciprocal tariffs apart from on China. But I think that we are far from out of the woods here. I think that these data do sort of still suggest that there is a slowdown coming in the economy.
So the slowdown is what worries you more than the inflation, David, if I'm hearing you correctly, at a time where CPI just came in, when you strip out energy and food at the lowest level going back to 2021. Are you saying that that's really what markets ought to be focused on, both bond and stock?
Yes, because people talk about stagflation all the time, but really it's always inflation stag. You get the inflation first and then you get the stagnation. And the problem is that, with the labor supply falling away, with these impediments to trade, with cutbacks in government spending, government grants and so forth, a lot of fiscal drag this year, I can see a lot of things that are going to slow the economy down. We'll get a temporary surge in inflation from this, but I think we're going to be left with a pretty stagnant economy afterwards. And the real question is, does that revolt in the House yesterday in terms of House members who are fiscal hawks, is that really something or not? Are we going to have a bigger deficit in fiscal stimulus next year or not? If we have fiscal stimulus, then I start worrying about inflation again. But in the absence of major fiscal stimulus, I think people need to worry about recession more than inflation here.
Are bonds still the best bet? U.S. Treasuries in that type of scenario, recession, comes very much back on the table.
Well, yes. I mean, I think that, first of all, I think, long-term interest rates at 4.3%, 4.2% on a 10-year Treasury, I think that's fine. And I think people need, I'd be level weight in fixed income. I realize that we may have a mild recession here, but, longer term, whatever recession we have, we'll pull out of it again. And these bond yields are reasonable for the long run. I don't expect inflation to hang around the long run because, we'll get these tariffs and then tariffs just don't work and eventually we'll pull back from them and that'll actually have a deflationary impulse in the economy. So long term, I'm not that worried about inflation. I am worried that there won't be much dynamism about the economy overall.
David, appreciate the update. I know you're busy this morning, so thanks for making time for us. David Kelly there of JPMorgan Asset Management. If you are just joining us, downside surprise on CPI. Market just kind of looks through it. Equities still session lows. We're down by 2% on the S&P 500. There is a bit at the front end of the curve. You see yields falling back by 8 basis points at 383 on a 10-year. And in the FX market, that unlocks further dollar weakness. Euro dollar through 111. We're at 111.15. Torsten Slok of Apollo is still with us. Torsten, David Kelly, calm before the storm. Focus on a growth story more than inflation. Do you agree with some of that?
Well, I'm not so sure. I mean, the last few days, the Fed has made very clear that they will also be focusing on inflation. So the real big question for them here is, do they want their legacy to be Arthur Burns or do they want their legacy to be Paul Volcker? Because if they walk out the door and have allowed inflation to be a lot higher, then of course they will have a serious risk. So I do think that this becomes a very, very important debate inside the Fed in terms of what weight should they put on the dual mandate when one side of the dual mandate says the Fed should be cutting, namely growth, and the other side of the dual mandate, inflation, said they should be hiking.
It's difficult to read minds, but based on the communication of the past week or so, do you get the feeling the weight of history is on their shoulders?
Because I do see some financial minor nuances between what's being said, in particular compared also with Jay Powell on Friday. Very importantly, can they get away with just saying, oh, we're going to cut because long-term inflation expectations in markets are very well anchored, because survey expectations are going up quite significantly, both in the short term and in the long term. So it really becomes a matter of where do they put their weight when it comes to inflation? Is it on actual incoming inflation, or is it on some measures of inflation expectations which are well anchored?
But Torsten, you said it earlier, you have tariffs still in the pipeline. Can they do anything until they actually understand the rules of the road?
I think they do the same calculations, of course, that the street is doing in terms of the impact on inflation is between half and a full percentage point higher over the next 12 months. Then I do think that they come to the conclusion that the forecast is saying inflation is going up, and therefore it's going to be difficult for them to signal a lot of rate cuts. So that's why the market currently pricing 3 cuts. It does make sense that we have a modest amount of cuts, but not more than that, even if growth does start to slow down more meaningfully.
Do you have a sense of how close they were to intervening with the Treasury market yesterday?
I don't know the answer to that, but I do know that they bought $100 billion during COVID, of course, in March of 2020, every single day in the Treasury market. And I do guess that they were probably worried that they would have to take out some of the same tools if this were allowed to continue. So if both it was caused by Japanese sellers, if the sell-off in rates was caused by risk reduction in asset managers, and if it also was caused by the basis trade unwinding, that combination and the fact that we don't even know which of these things were most powerful just still created a significant amount of risk to financial stability if this were allowed to continue.
Do you think people are trying to drift away from dollar assets? Do you see that building over the past week?
I don't see that, because the dollar would have gone down a lot more in the last few days than it actually did. So there are some discussions around maybe China or others were selling in custody holdings and just kept the money in dollars and didn't sell it and took it back home. But nevertheless, the fact that the dollar index just moved relatively sideways, the yen did appreciate, suggesting that it's correct that there might have been some Japanese sellers. But broadly speaking, the DXY index on my Bloomberg screen was relatively flat for the last few days, suggesting that this was not a questioning about US exceptionalism. I still think the US is exceptional, still the most dynamic economy, still the biggest financial market. We still have, of course, a lot of investors that are looking here to come and invest, and that does make sense. We just have, at the moment, some turbulence, of course, that people are thinking about, that this is probably mainly viewed as a short-term quibble in markets.
I hope you're right, Torsten. Well said. It's good to see you, as always. Torsten Slok there of Apollo. Equity futures at the moment down 2% on the S&P. The opening bell is about 43 minutes away, with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March headline and core CPI both rising less than expected. A softer print with markets weighing the whiplash from the White House. The data is a welcome signal for the Fed. The central bank so far has been saying that it's prepared to stay on hold as it awaits any inflationary impacts from tariffs. And we have a deal in the luxury retail space. Prada is buying Versace from fashion conglomerate Capri Holdings. Prada will pay $1.38 billion for the company. Capri said it will use the proceeds of the sale of the business for investments, debt reductions, and stock buyback. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Live from New York City, you're watching Bloomberg Surveillance. Downside surprise on CPI. This equity market not taking comfort from that. We're down by 2.2% on the S&P. We're down 2.8 on the NASDAQ. As we count you down to the opening bell, should we get you some movers? We can get those movers right now. Let's cross over to Danny Berger, I believe, for more. Hey, Danny. No, Danny. Let's get to your trading diary. At 1 p.m., the US Treasury auctioning $22 billion in 30-year bonds. At 4 p.m., President Trump participating in a bill signing. On Friday, PPI and UMich sentiment, plus bank earnings kicking off with JPMorgan, Wells Fargo and Morgan Stanley. On Monday, Goldman Sachs earnings. Tuesday, Bank of America and Citi reporting, plus United Airlines results after the closing bell. One thing that is happening right now, I'm pleased to say, Speaker Johnson and Leader Thune will be holding a news conference, a briefing, any second from now. Tyler Kendall joins us from Washington with more. Tyler, what are you looking for?
Yeah, hey, John. Well, this presser comes after last night the House delayed a crucial vote on passing the Senate's budget resolution. At issue here is that fiscal hawks in the House don't think that the Senate's plan has enough spending cuts. The Senate plan calls for about $4 billion worth of spending cuts. You'll recall the House had wanted that number to be up to $2 trillion. Now, there is reporting that the two leaders could be announcing here a deal for $1.5 trillion in spending cuts. We'll have to see, because that is still going to raise some pretty big questions when it comes to what that could potentially mean for some benefit programs like Medicaid that really started this disagreement between the two chambers to begin with. John, these two chambers do need to ultimately agree in order to kickstart actually crafting the budget reconciliation process, which President Trump is really banking on because it's tied to his tax cuts.
Tyler Kendall, thank you with the update from the White House. Tyler, thank you so much. Annmarie, are we getting closer to this deal? How long is this going to take?
Well, obviously, having Speaker Johnson and Leader Thune come together and talk about potentially how they can bring both their caucuses together. Yes, we are getting closer, but this is going to be so challenging. Because say you have these fiscal hawks in the House that say, I'm not signing up for something until I see the Senate cut back on some of their spending. Well, then you're just going to have Republican senators saying, there's no way I'm touching anything close to Medicare. So you're going to have this dance back and forth for a while. Push is going to come to shove if they include the debt ceiling within the package, and they have no choice but to vote on it. And also when Speaker Trump starts getting on the phone and pressuring these individuals to sign up to his plan.
The president says the biggest tax cuts ever. There's a big difference between extending tax cuts and delivering new ones.
These aren't tax cuts.
Are we going to get additional tax cuts?
Potentially. We'll get no tax on tips, maybe one other add-on, one other sweetener. But all this is an extension of current policy, which is why, Erika was talking about it earlier. This is all already baked in. There's nothing that exciting about this bill. I know it's one big, beautiful bill potentially for the president, but all it is an extension of current policy.
That would have implications for this big, beautiful bond market at the same time.
Very much so, because if you end up with a bigger fiscal deficit, then all of a sudden, how much does that become the main driver? I remember a long time ago, like 3 days ago, when people were actually talking about how the bond market cared more about the budget than they did tariffs. Well, that changed for a hot second. But now there's going to be also a focus on the fiscal sustainability, especially if there is Japanese selling, especially if there is potential aversion from international buyers. We've heard mixed things, but that, I think, will become very much to the fore.
3 days ago feels like an absolute lifetime ago. Just yesterday, the president backing down, authorizing a 90-day pause on tariffs and doubling down on China, 125% on China. That unleashed a major rally in the equity market, the biggest one-day move we've seen going back to 2008. This is what Peter Chi of Academy said this morning, a Liberation Day do-over. And that's exactly what it feels like. Where will we be 90 days from now? Will we have to have another pause for another 90 days? And what happens in between? This market is not paying attention to the economic data. A downside surprise on CPI, and we're taking very little comfort from it. Your S&P 500 is down by 2 full percentage points. Coming up tomorrow to continue the conversation, Cameron Dawson of New Edge Wealth will be catching up with us as bank earnings season kicks off. On Wall Street, we'll catch up with Gerard Cassidy of RBC. We'll speak to Sarah Hunt of Alpine Saxon Woods, and we'll catch up with Veronica Clark of Citi before we go into a much-earned weekend for you all. From New York City, enjoy the Masters at Augusta National. From New York, get some rest if you can. This was Bloomberg Surveillance.